While we all are busy with our daily routines, with work at office and then at home, it is definitely not easy to stay on top of all the decisions which has been announced recently. It feels like taxman's battlefield, where decisions are fired onto us and we have been given the task to put it to right perspective. One thing we are always proud of is that ICI Dubai chapter, its member, are always the first to lead from the front. The best example is that the most awaited cabinet decision, number 55 on qualifying income, was published on 1st of June, followed with Minister Decision 139 on qualifying activity on same day. And here we are, with room full of intelligent members, where our elite speaker, CA Manu and CA Nirav Shah, also well prepared to educate us what's included in those definitions which were announced. So can I have a big round of applause for ICI Dubai chapter, its speaker and our members. It would be incomplete without recognizing our chairman, CA Harikishan Rankawat, who is putting efforts on a daily basis, because I talk to him on a daily basis and I see how much he is attached to the chapter every day. So I want to, from my whole heart, give a big round of applause to our chairman, CA Harikishan Rankawat. Thank you, sir. Your efforts are always appreciated. Like before starting any occasion which is so close to our heart, we always pay respect to what brings us here. So let's all of us rise to pay respect to our national anthem of India and UAE, followed with ICI motto.
सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः श्रितः सर्वे तदूनात्यपि कश्चन एतद्वैता
Thank you, everyone. Please take your seats and let's move and invite the chairman of our chapter, who leads the chapter from front, CA Harikishan Rankawat.
ये दिनेश कोठारी, गैलेक्सी और पास्ट चेयरमैन, वाइस चेयरमैन सी राजेश सोमानी, स्पीकर्स ऑफ द डे CA नीरव शाह, CA Manu Palerichal, my colleagues in the managing committee and respected members of the chapter, a very good evening to all of you. Guys, I think you have taken a cup of tea and snacks as well. Good evening. I welcome each one of you to our UAE Corporate Tax event today. Today, you know that our speakers will be mainly focusing on free zone and one of the explanatory guide and participation exemption. Tax-free period, as you guys are aware, that is already over and 1 week ago. And UAE has become now low tax country from no tax country. And as you are aware that there are many CDs, FDs, and MDs. So I mean cabinet decisions, FTA decisions, and ministerial decisions. All those were issued during the last 1 month, and we have been struggling and juggling in between. But today we have got expert speakers, so definitely they will demystify all the decisions, whatever has been issued during the last month. Now, as you guys are aware that corporate tax registration has already started, and if you are individual and running business in personal capacity, having an annual turnover up to 1 million dirham, then you guys don't have to register for CT registration. But if it is more than that, yes, you have to register for CT as well as you submit your corporate tax return as well. Now, there are like small business relief. If the annual turnover is up to 3 million dirhams, although the profit may be more than 375,000, you don't have to worry. There is a relief. But yes, you have to register as well as you have to submit your corporate tax return on annual basis. And now, as you guys are aware that carry forward of the losses, they have given like indefinite period. You can carry forward as long as you want. So this is one of the very welcome move which we have not seen in other countries. Real estate investment in the hands of an individual, trust or foundation, it will be completely out of scope of corporate tax. If the annual turnover of your company is more than 200 million dirhams, then yes, it is mandatory. For the transfer pricing, you guys have to keep local file as well as global file. But if your turnover, group turnover for your maybe multinational enterprises is more than 750 million euros, then you have to maintain CBCR apart from local and global file. And OECD BEPS Pillar 2, which has established a global minimum tax rate of 15%, I think there is no further clarification as yet from the ministry, but I believe that Ministry of Finance is working seriously on that global minimum tax as well. So you have to wait and watch. And I always emphasize on one thing, on GAR, General Anti-Avoidance Rule, which has already kicked in before the corporate tax was implemented. So if you are changing anything, increasing or decreasing the salary, rather you will always increase the salary of your, if you are an owner or a partner or any related party, be careful. You need to have proper transfer pricing documentation. If you are having, or if you are changing your financial year or accounting year, then be aware. I mean, we have to have proper rational and economic decision. If you are changing the enterprise structure, like from the mainland, you are moving to free zone, you need to have proper rational and economic decision. Otherwise, whatever changes you are making, it might be rolled back. So we have to be careful of GAR always. And now I will come back to the events. During the last 15 days, we have organized cricket as well as badminton tournament, and members have really participated in a big way. It was a very successful event. I think a lot of members, you guys would have participated in that. So I look forward for further participation in the sports events in future. Also will come back. I think Rishi is working on bowling event as well as on the chess. So let's hope for the best. And now I will just highlight on the forthcoming event. We will have our next corporate tax seminar on 17th of June. That will be organized at Movenpick Hotel, Dubai Airport. So here, I mean, always we have been discussing on the UAE corporate tax, but in this seminar on 17 June, we will discuss beyond tax. So what we have to do beyond tax, there are so many things, and I have got a very good speaker who knows exactly. And so I would like to welcome there as well in a big number. Then on 26th of June, we will have our study tour to Pattaya. स्टडी टूर टू पटाया जो बोलते हैं तो लोग हंसते हैं, और वहाँ पे इमिग्रेशन में भी पता नहीं क्या रिएक्शन होगा, बट एनीवे, so it will be for 5 days and we are flying on 26th of June. Now on 2nd of July 2023, we will have our blood donation drive because we have the CA day in order to celebrate the CA day, which is on 1st July, but 1st July we'll be coming back from Pattaya, so we'll celebrate on 2nd of July our CA day. And on 8th July, we will have one of the seminar on the Indian stock market, India's turning point, where our expert speakers from Sundaram Asset Management will share their insight into how to create wealth from the Indian equities. So please, and this seminar will be organized at Address Marina, Dubai Marina. Once again, I would like to thank our speakers as well as a special thank to our chief guest, CA Dinesh Kothari, for devoting their time out of their busy schedule for our members. Can we have a big round of applause once again for our speaker and the chief guest? Thank you very much, and happy learning. Thank you.
Sports event, so he doesn't let us sleep, basically. Now is the time to hear from our guest of honor, CA Dinesh Kothari ji. Thank you so much, sir, for accepting the invitation to become guest of honor for us. He is Vice Chairman and Managing Director of Delhi Private School. He has a lot of accomplishments under his name, but something that personally inspires me is his calm and composed presence and his captivating Shairana andaz. And to formally introduce him, I'd like to request our Vice Chairman, CA Rajesh Somani ji, to please come on the stage and introduce CA Dinesh Kothari ji. Big round of applause for Rajesh ji. In the meantime, after the introduction, may I request technical team to play the Delhi Private School after the introduction. Thank you.
Very good evening to all of you. Very good evening. Respected Kothari ji, eminent speaker Mr. Manu, Mr. Nirav, our chairman Mr. Hari Kishan, other member of the committees, and prominent chartered accountants, including past chairman. I have been asked to introduce the gentleman who does not need the introduction. Kothari ji is well known among all of us. His growth journey is synonymous with the UAE growth journey of more than 4 decades. He is among the senior most member in our profession in UAE. His name is synonymous with education and DPS. He started his first education institution in his native place or his mother state, Rajasthan, as a no-profit organization to give back to the society in a way. Then he again contributed in this part of the world by having DPS in Sharjah, then Dubai. And he is an active, I should say, the society member or the community member who keeps his presence with silence, without noise. His simple presence among all of us itself raised the bar of the event and the grace of the event. We are really proud today to welcome him as a chief guest of the event, and we feel proud to find him among us today evening out of his busy schedule. So welcome to the today event, sir, and thank you very much for joining us. Give the big rounds of applause to Mr. Kothari. Thank you.
Thank you. So now with big round of applause, please join me in welcoming CA Dinesh Kothari ji on the stage.
Good evening, namaskar, assalamu alaikum. राजेश जी ने मेरा इंट्रोडक्शन दिया आपको. ये कहना तो सब ठीक नहीं होगा कि मैं इस काबिल नहीं हूँ क्योंकि आप झूठ नहीं बोलते हैं. मगर लास्ट थिंग आई वुड नीड इज इंट्रोडक्शन अमंगस्ट my fellow professionals. When Haribhai rang me up last week and said, you have to come as a chief guest on this tax seminar, as a chartered accountant, I'm supposed to know about taxation. The painful part is when you don't know anything about it. And therefore, please expect nothing from me to talk about taxation because people who are coming to speak about it are so knowledgeable that I think all of us are going to take a lot from here this evening. You know, normally taxation, when you talk about tax and income tax or whatever tax, there's a sense of pain inside, as if somebody is going to take away something from you. Obviously, in UAE, we have been to some extent spoiled for our habits for not paying tax for the last 52 years. But in any society, in any country, there are two elements that are important. Number one, you're on par with the international level organizations, countries. So you are on par with them and you're not privileged. And that means also that you are basically trying to eliminate quote-unquote tax haven status. And that's what every country desires to do, that they don't want to be in the gray list. So there's a lot of pressure on international platforms, international forums to bring UAE also in par, in line with global scenario. So that's one reason. Second, knowingly or unknowingly, we always expect there is a government which is supposed to do everything for us. May it be infrastructure, may it be education, may it be healthcare, better roads, and so on and so forth. Where does the government get money from? At the end of the day, if we are going to benefit and enjoy all those infrastructure and benefits which government is supposed to create for us, we have to partner and contribute in that. And government is only taking away a very small portion, fraction of the portion from our net profit. They are not taking from our capital. I'm a great advocate of taxation, by the way, though I've enjoyed tax-free for 48 years in this country, tax-free regime. I feel that we all owe it back to society, like we want to give in some form or another. And what could be better form that rather than giving charity, we contribute to the government coffers, which will come back to us and our children in the form of infrastructure, in healthcare, education, and so on and so forth. The brighter side of it is, it's fantastic for news for chartered accountants, all of us. We are going to get fantastic business opportunities in years to come. Our duty is going to be to ensure there is no tax evasion, but there should be some tax planning. It could be tax avoidance, which I am sure our experts will talk about it as to what we should do and what we should not do. Evasion is going to be crime. And one thing I can tell you, having lived here for 48 years, you do everything in this country but don't break the law. Not only the one who breaks it is punished, but who helps in abetting this, breaking this law is equally punishable. And I think government has made its intentions very clear in anti-money laundering bill and so on and so forth, that we are equally accountable should we be a party to doing anything wrong. The days are gone where we could get away by doing few things which we should not have done, and let's not take pride in doing that. So we have also moral, social obligation to make sure that what we do is correct. Because what we do correct is not only going to hold our profession or our institute on high esteem, but will set the path, role model to our generations to come. Because our children will learn, because now they'll grow in a taxation era. Therefore, they should grow up and grow into being good citizens. And I think we owe a lot of moral obligation towards them, more than anything else. It's going to be an interesting seminar. In fact, I've been trying to read Nirav a little bit on taxation. And I honestly tell you, the only thing I could understand from IT was information technology, which is what we use in the schools. I couldn't relate it to income tax. Because I've forgotten it all about it in 48 years. So I'm sure we are going to learn from you and Manu as to what it is all about. And I personally look forward to it because it affects. I've had wonderful years, 48 years in this country. I came here 74, much younger than what I am today. Though I was reminded that I'm among the senior most member of the institute present today evening. Thank you, Rajesh ji. उम्र का बढ़ना तो दस्तूर जहाँ है, नहीं महसूस करो तो बढ़ती कहाँ है. हम तो महसूस नहीं करते. Because all of us, there are two things which I keep talking to my students in the school is, there are two things in life, one which is mandatory and another which is optional. Growing old is mandatory. We do nothing today, we are one day older tomorrow. We do nothing for the whole year, constructive, positive, nice. We'll grow 1 year older next year. But growing up is optional. That's up to us. Do you want to grow up or you want to grow old? I think we all want to grow up. We belong to a most fabulous, noble profession. And I'm so proud of that my parents forced me to become a chartered accountant. I wanted to be an engineer. I don't know, I would have been standing on some site somewhere. And some bridge would have been collapsing in Bihar and I would get the blame. At least I don't have to go through that. So I think ours is a fabulous profession. We should be all proud of it. And collectively we owe it to our profession that we hold the morals high. And that's so important for all of us. So it's the era of growing up, era of new phase, a completely different phase, which I think most of us were not used to. And therefore, there's a lot of education. And the taxation, since its nascent stage has just started, there'll be a lot of evolution. It will evolve as we go along. And we have to keep ourselves abreast with that, make sure we do what we are supposed to be doing, and most importantly, not do what we are not supposed to be doing, because that's going to be pretty harsh, and the government is not going to take it lightly. So we have huge responsibility, not only towards us, but towards our clients, to our advisors, to whom we advise as to what they should not be doing, because that's going to be important. I'll end with one nice share which I enjoy reciting. कि फला फूला रहे या रब चमन मेरी उम्मीदों का, because I belong to this profession, I'm one amongst us. फला फूला रहे या रब चमन मेरी उम्मीदों का, जिगर का खून दे दे कर ये बूटे मैंने पाले हैं. ये जो हमारे प्रोफेशन में हम लोग बड़े हुए हैं, ये हमने जिगर का खून दे दे कर बड़ा किया है. ये हमारा फ़र्ज़ बनता है कि हम इस बूटे की हिफाजत करें, इसकी परवरिश करें, इसको हम बचा के रखें, क्योंकि मुश्किलें तो बहुत आएंगी हमारे सामने, मगर द टेस्ट ऑफ द पर्सन इज़ व्हेन ही कैन walk through the difficulties with holding his head high rather than succumb and compromise. So with that, I wish you happy learning, and I hope we'll all join in listening to our experts and learn and take home on taxation. Thank you so much.
And the opportunities that is bringing, that is coming because of taxation. So thank you for sharing those thoughts. Now it's time for appreciating and with a token of love from the chapter to CA Dinesh Kothari ji. So I'd like to request our chairman, vice chairman, our former chairman CA Raju Menon to please join me on the stage for giving a small memento to CA Dinesh Kothari ji. Thank you. One of the pressing questions for this year for finance people like us, which has kept us on our feet, is when will the definition of qualifying income come? Do you agree with me? There has been a lot of deliberation whether free zone service income will be taxable or exempted. Many businesses were looking to restructure their business model into free zone, to do it or not to do it, whether do it now or later. So there were a lot of questions. Now, other thing which was there, whether it'll be all the free zone or the designated free zones like VAT or excise. How will the transaction with mainland will happen? And how the substance will be proved? So the questions were like going on and on without an end to it. The extent of excitement was so huge for this decision, as if we are looking for Amitabh Bachchan to come on the stage for us. So it was so important. Definitely it was so important. Here we are, and the wait is over. Last Thursday, 1st of June 23, where two important decisions were published: Cabinet Decision number 55 on qualifying income and Ministerial Decision 139 on qualifying activities. While we all are contemplating to demystify this with various permutation and combinations, we have a very learned speaker as our first speaker, CA Manu Pellerichal, with us, who's going to talk to us about qualifying activities and excluded activities and also qualifying income. We all know Manu as a person with a smiling face and a force of positive energy. Something I've always personally admired about him is never to say no attitude and willing to go an extra mile, as we can see today. Though I can speak for another 30 minutes about Manu, but let's use the time for this session. And before inviting him to the stage, I'd like to request our ExCom member, CA Ashna ji, to please join me on the stage for his formal introduction. Please give a big round of applause for CA Ashna to be on the stage, please. Thank you.
Good evening, ladies and gentlemen. Oh, wow. One thing that's common among all of us here today is we are qualified chartered accountants. And now the task with us is to understand what is qualifying income, qualifying free zone, and the list is endless here. But one amongst us, Mr. Manu, will take us through the session today. Does Manu need an introduction? Yes, he doesn't need an introduction. But he's the CEO and founding partner of Emirates Chartered Accountants Group. He's a certified management accountant and started his journey in Dubai in 2003. He currently holds honorary positions: Vice Chairman at International Chamber of Commerce, UAE Customs and Trade Felicitation Commissions Board. He's also a board member of Association of International Tax Consultants. Without taking much of your time, I now invite CA Manu.
I've prepared a slide, around 30 slides or 25 slides effectively. But the only slide which I didn't look at is the content, because all other area I prepared. And the last moment, I gave to my colleague that whatever you feel from the slide, you put it. When I check now, I can't see something which is there in the main topic. Like you can see here, excluding activity, excluded activity is not there. Is there? No. I don't know whether she removed the slide also, the respective slide. Then qualifying activity? No. Qualifying income is there, qualifying activity is not there. But I'm sure the slide will be there. You are going to take. Sorry? You are going to speak on that. I'm going to speak on that, definitely, because it is covered under transaction with a free zone person will be covering qualifying activity, and transaction with a non-free zone person will cover. Did I make any mistake? Yes. That's what I want to check. In this session, I'll be checking like this. Because, do you agree with me? Is it a confusing topic? Anybody is having confusion on any of the topic, any of the clauses or articles? Anyone here with the no answer? Yeah, many of you. Anyway, everything is clear for you? No. Which is more confusing? which is more confusing for us? CT law itself, but I'm talking about the two topics today, cabinet decision 55 and ministerial decision 139. Of course, one more, cabinet decision 55, 56 also I will cover, but mainly these two. In this qualifying income, is it a confusing area? No. Qualifying income includes non-qualifying income or? To a certain extent. Qualifying activity is a confusing area? Yes, for some people. Excluded activity? And de minimis rule? No. Anything else? No confusion. So, qualifying activity and excluded activity. If any confusion is there in this area only. Today I am going to cover all this area and let us discuss and learn together. And at the end of the session, I will give you 4 steps how to identify a transaction, whether it is taxable at 0% or 9% is applicable. In 4 steps, I made 4 steps to identify each transaction, whether it is taxable or not. Let us start with the qualifying free zone persons. The definition everybody knows. Qualifying free zone person is a free zone person, a juridical person which is incorporated in a free zone or branch of a foreign juridical person. What about branch of a mainland company? That is also a qualifying free zone person. Nothing mentioned in this one. But here I take a stand. Branch is not a separate legal entity. If branch is not a separate legal entity, it is part of main. So mainland. So it's part of it. Different opinion can come. We can discuss everything. And a panel discussion also available, questions, and around 1.5 hours we'll have a discussion here. And my friend Nirav Shah also there to give his view on it. Let us see what is the next step on it, subject to corporate tax under 3(2) of the law. Under Article 3, Clause 2, it says, what is the taxability of a free zone person? Qualifying free zone person has to be taxed at 3(2)A and 3(2)B. And certain conditions to be satisfied to be considered as a free zone person. So what are the conditions? Article 18 mentioned 4 conditions plus 2 more conditions from the decisions. So if a free zone complies with this requirement, then it can be considered as a qualifying free zone person. To check these conditions, 6 conditions are there. Number 1, whether it maintains adequate substance in the state. Core income generating activity should be in the free zone. Assets, adequate assets, adequate number of employees, adequate operating expenses to be incurred in the free zone. So if these conditions are satisfied, then it will be considered as it has good substance in the free zone. And it should derive qualifying income. I'm not going to explain what is qualifying income now. I'll explain in detail later. And it should not elect to be a taxed at 9% as per the corporate tax law. That means it should not elect to be taxed at 0% up to 375,000 and then more than that 9% tax bracket should not select. Number 4, transfer pricing regulation compliance is mandatory for free zones, and de minimis requirement is the 5th one. Its non-qualifying revenue should not exceed de minimis requirements. That also we will cover. And the last one, for some of you it is happy, so audit is mandatory. So these are the 6 requirements to be considered as a qualifying free zone person. Now, suppose the free zone which plan to choose the path of qualifying free zone person couldn't meet any of the requirements, then it will not be eligible to be considered as a qualifying free zone person the current year and next 4 years. That's a penalty. Option available for us, whether to opt to charge under 3(1) of the law. That means whether to be selected the option to charge at a normal rate. This election has to be taken before the end of the tax period, or you can take in advance for the next financial year. This election has to be taken either in the current year before the end of the financial year or in the subsequent tax period or for the subsequent tax period. That means before the last date for selecting the option as 31st or whatever, the year end, the financial tax period year end. If we not elect go for normal tax rate, then later if we fail to comply with any of the 6 conditions, we will be losing the qualifying free zone person status for 5 years. Now the checklist comes. Are you a free zone person? Yes. Do you maintain adequate substance in the free zone? No. Then elect to be taxed at the normal rate. If you are maintaining adequate substance, then deriving qualifying income? No. If you are not deriving qualifying income, elect to be at a tax normal rate. Then otherwise, if you are deriving qualifying income and satisfying de minimis requirements, then you can retain as a qualifying free zone person. Having the other requirements like transfer pricing compliance, auditing of financial statements and procedural aspects. You have to check this before the end of the financial year whether you are able to comply with these requirements or not. An estimation may be required for the de minimis requirements. De minimis requirements means qualifying income related and all, you have to calculate and arrive the formula. We will discuss in detail. Now, qualifying income. What is qualifying income? I would like to categorize this into 3 for arriving the qualifying income. Number 1, for a transaction with a free zone person, if you are in a free zone and dealing with another free zone person, whether in the same free zone or in another free zone, but with another free zone person, transactions with free zone person except income from excluded activities. Excluded activities will not be considered as a qualifying income as a first step. Number 2, we will go to the non-free zone person, transactions with the non-free zone persons. In the case of non-free zone persons, only qualifying income from the qualifying activities will be considered as qualifying income. Excluding activities. That means qualifying income only will be considered as qualifying activities, the income from transactions from qualifying activities will be considered as qualifying income. Those qualifying activities should not include the excluded activity which are mentioned there in the separate clause. It's not confusing. When we read in the first round, second round, third round, it is confusing. Again, fourth round, it will be smooth. We can understand. We are going to that step now. So here, in the first free zone persons, this is the total income. Suppose this box is the total income of a free zone person. Excluded activity, which is showing in black, is taxable. Non-commercial property income will also be taxable. Other white color is 0%. Why commercial property and all, I will come to that one. Just for your basic information, excluded activity figures or the chart in black is taxable, others are not taxable. Going ahead, for non-free zone person, only qualifying activity which is not excluded are not taxable. Going ahead, there are some other income which are not considered here, which are excluded activity or non-qualifying activity. That also will be considered as qualifying income. So excluded activity and non-qualifying activity income also will be considered as qualifying income, provided de minimis criteria is met. So if any excluded activity is conducted by a company, qualifying activity is conducted by a free zone, and some excluded activity also conducted, this excluded activity, whether this can be considered as a qualifying income to the extent of de minimis. Last, permanent establishment of domestic or foreign PE. Domestic PE or foreign PE income will not be considered as a qualifying income. It will be taxed at 9% as per 3(2)(b) of the clause of the law. And last point, immovable property. Only income from commercial property, income generated from a free zone person. If customer is a free zone person, and income generated from a commercial property, it will be considered as a qualifying income. If your first time, if you didn't go through the law, it will be difficult now to catch up everything. It's like a CA course itself, very difficult. But if you have gone through and confused yourself, it's not possible to understand in the first stage. And there are experts sitting here, I know, who knows everything. And if anything is wrong, I am telling, then you can also contribute. But I'm sure that this is the steps, and by the end of the day, everybody will be able to understand all this. I'm sure about it. We can take a step. In 4 steps, we will understand it. Transactions with the free zone persons. So, transaction with a free zone person, non-free zone person, and other income, which is not covering in A and B. So, one by one, we are going to learn now. Transactions with a free zone person. That's why the list of excluded activities come. If you are dealing with a free zone person, all income will be taxable, all income will be qualifying activity. All income from the qualifying activity will be a qualifying income. All income will be a qualifying income, except the income from excluded activity. In the law, it is specifically mentioned that 6 items are excluded. Only 6 items. Simple. What are those excluded activities? When you are dealing, if you are dealing with a free zone person in a free zone, by a free zone company, giving service or dealing goods with a free zone, excluded activity will be considered as taxable. What are those excluded activity? Income from certain regulated financial service. I would like to categorize this in like this. From certain regulated financial services, banking activities will be excluded, will be taxable. Insurance services, except reinsurance. If you are dealing from free zone, for example, DFC, and doing insurance activity, it will be taxable, except reinsurance services. Number 3, if you are doing an activity of financing and leasing, can take a stand, financing and leasing is taxable. It's an excluded activity. It is taxable, except 2 cases, financing and leasing of aircraft, including the engine and rotable components. Number 2, treasury and financing services to a related party. These 2 are not excluded. All other activity of financing and leasing activity will be excluded, will be taxable. Then the other category I am going, this is finance, this is bank, the services related to regulated financial services. Another category I am going, the intellectual property, the ownership or exploitation of intellectual property. The income will be always taxable. So straight away you can take all banking will be taxable. All intellectual property income will be taxable in free zone also. Number 3, third category, ownership or exploitation of immovable property except transactions in respect of commercial property located in free zone. So this I will explain later in detail, but initially I explained, but I have a chart. So free zone, commercial property related, certain exclusions are there. And last, any transactions with the natural persons, except transactions in relation to 4 areas. What are the 4 areas? Fund management services, wealth and investment management services, operation management and ownership of the ship, and financing and leasing of aircraft, including engines and rotable components. If you are natural persons, except these 4 activity, everything is excluded. Simple. Confusing area is this one, with the natural person, whether it is taxable or not. Just to keep in mind 4 items. In a free zone, if you are dealing with a natural person, free zone company, dealing with a natural person, or if only 4 items are not taxable. Other than 4 items, everything is taxable. Then the next one, designated zone, I am selling, and all this, just keep in mind 4 items, the remaining everything is taxable. This is called FAWAS. I created an acronym, but it didn't come here. FAWAS, F-W-A-S. So fund management, wealth and investment management, ship related, and aircraft related. Aircraft and ship is related to personal, and then remaining fund and wealth management. Next, transactions with the non-free zone persons. So this is clear overall? Am I slow? Should I make fast? Next one, transactions with the non-free zone persons. Non-free zone person is only with the mainland, or any other person also includes? Free zones other than the free zones. The free zones outside the free zone means either in the mainland or outside the UAE, outside the state. So transactions with the non-free zone persons. Here qualifying activities. How many qualifying activities are there? around 12, it's exactly 12 and ancillary activities. So 12 items are there, which a free zone person doing business with a non-free zone person, either to the mainland or to the overseas, will be considered as qualifying income, and then it will not be taxable at 9%. It will be 0%. Normal, tax benefit will be available. Only 12 activities. Number 1, manufacturing or processing of goods or materials. Second one, distribution of goods. I would like to just keep that sentence with distribution of goods now. I'll not explain it now. I have 2-3 slides for that. Distribution of goods to the mainland, distribution of goods to overseas, and it is nowhere coming, it is going through the sea. All these options we will discuss. Then another category, the qualifying activity, ownership, management and operation of ships, financing and leasing of aircraft. These are qualifying activity, and qualifying income will not be taxable. And next, reinsurance service, fund management services, wealth and investment management services subject to regulatory oversight of the competent authority. So this is applicable everywhere when these financial services are coming. So this also a qualifying income. And last part, treasury and financing services to related party, headquarter services, logistic services, holding of shares and other securities. These are the 12 categories of services. Out of this, certain items we connected with excluded activities. That is a confusion. That we have to remember. Here you see reinsurance services are qualifying income, qualifying activity. Since it is qualifying activity for a transaction with a non-free zone person, and there the insurance is excluded totally, so it will be taxable. When you are dealing within the free zone, it is better to avoid reinsurance activity. That's why it is connected. When you are doing financing activity is taxable for a free zone too. Financing activities, here you can, what is a financing activity where it is? Yeah, reinsurance or fund management. Yeah, financing activity, financing and leasing of aircraft. It's a qualifying, eligibility is there. That's why it's specifically excluded. Give an exclusion to the excluded activity. So that's how it is connected. Just to remember those connections, it will be clear. And we have examples we can discuss one by one. These two areas, qualifying activity and excluded activities, to some extent it is understood. Can we move ahead? De minimis requirements. Qualifying income from qualifying activity and qualifying income from other than excluded activity, that's free zone, and with the non-free zone. Remaining something is the other income. This income also qualifying income, and you can get the 0% benefit to the extent of de minimis criteria. What is de minimis criteria? 5% of the total revenue. De minimis requirements are whether this part of your income is 5% of the total revenue or 5 million. This criteria we have to check. How to check? Do you earn any non-qualifying revenue? Yes. Whether non-qualifying revenue is more than 5 million? Yes. De minimis criteria is not satisfied. You will not be eligible. You will not be eligible to get the tax benefit. And in the case of, if you are not earning up to 5 million, your non-qualifying income is not up to 5 million, but it is less than 5%, then you are eligible. Means de minimis satisfied, otherwise you are not satisfied. It's a simple formula. We learned a lot of formula, so this is simple. And what are qualifying income and what are total, qualifying revenue and what are total revenue? we have to understand when we go to the de minimis area and all. This de minimis criteria is brought up to check, to identify what will be the tax rate for the category. The category, the bracket where you fall into. That's why that board. There it is set, when we are looking into de minimis, it is the non-qualifying revenue and total revenue. Now, non-qualifying revenue divided by total revenue should not be more than 5%, or non-qualifying revenue should not be more than 5%, 5 million. It should not exclude. What is non-qualifying revenue? Earlier I shown a picture. When a free zone company is dealing with another free zone company, excluded activities are there which is normally charged at 5%. Take that one. When a free zone company is charging to transacting with a free zone another non-free zone company, free zone to non-free zone company, other than qualifying activity is there. Take that one as well. It should not include certain items. Income from domestic or foreign PE, transactions with any person, non-commercial property, and transactions with a non-free zone person in the case of commercial property. This also will be clear. Just to keep in mind, 3 categories. One, property related to be removed, taxable part of the property to be removed, and domestic or foreign PE tax related, their taxability, revenue also should be removed. Excluded activity, other than excluded activity, non-qualifying person or dealing with a non-free zone person, from that you remove these 3 categories. Anyway, it will not come, the domestic and all will not, free zone, commercial related, you remove it, it should not include. Total revenue, from the total revenue, the whole revenue of the company, then it includes, you should remove all the 3. All the 3 have to be removed. One is the transactions with the non-free zone, transactions with the non-free zone persons in the case of commercial property, transactions with any person in the case of non-commercial property, and revenue attributable to domestic and foreign PE. Did it didn't well, or it's okay? It's okay? Manageable. Here, it's simple. Where we found free zone, we identified something as excluded activity when we are dealing with free zone. We identified something as non-qualified activity income when we are dealing with non-free zone person. From there, something is there that should not be included, that one in the case of qualifying revenue. Total revenue means from that property related taxable part you remove. Taxable part you remove, non-taxable part will be included there. We will go in detail the taxability of the free zone, means on the immovable property now. %9% will be taxable in the case of, this is self-explanatory, but I'll show this one with a slide picture representation that will be more interesting or easy for us to learn. I think picture is this one. Okay, this is better. I will go back to the other slide after finishing this. A property can be owned by a free zone person. Natural person I just added. Anyway, more questions will come related to that one later. So I thought that, okay, I can address this one now itself. A property located in a free zone, and if it is a commercial property, income from free zone person will be taxed at 0%. Income from non-free zone person will be taxed at 9%. In the case of other than commercial property, everything, whether you are dealing with a free zone person or non-free zone person, will be taxed at 9%. In the case of personal investment, if you are natural person, as a person, not subject to tax, and if it is with personal investment, It's not a personal investment. If it's a business nature, then it will be taxable at normal rate. Just an example, a free zone company, maybe in DMCC or maybe in JAVSA, just an example, designated zone or non-designated zone. If you are doing a business center activity, it is a commercial property located in free zone. Income from transactions with the free zone will be taxed at 0%. The last one you can check, income from non-free zone person will be taxed at 9%. Here, business center, commercial property located in free zone, same category, dealing with the free zone person will be 0%. Non-free zone person will be taxed at 9%. So if you are leasing out, if you are a mainland company and leasing something in the free zone, then it will be taxable for us. Taxable for the supplier, for the company in free zone. If it is leasing to someone else in the same free zone, it will not be taxable. I have given a time limit, but I will cover. Nexus in the state. A foreign juridical person having a property in the UAE, immovable property, which all the immovable property, they explained in the law, then it will be taxable in the UAE. What about the natural person? I have to check whether he is in a business or not, personal investment or not. Shah Rukh Khan having a villa here and leasing out and earning income 900,000 provided he is not a resident in the UAE or non-resident, whatever it is. Taxable or not for him? But instead of in his personal name, it's managed or he is operating through a company. It will be. Even then 900,000 will be taxable. If it is 1.5 million, same scenario. This scenario is same. If it is personal only, the 1 million bracket is available. This is very interesting. Without this, I can't leave the stage. This is something you can learn everything from this slide. Free zone juridical person, whether he elected to be a taxable person under 9% normal rate, yes, then he is taxable at 9%. Or income from income, that is taxable. Then if he elected, if he didn't elect, whether he maintained substance, check it. If he doesn't maintain substance, then taxable. If he is maintaining audit financials and transfer price and regulations complied with, if no, then also will be taxable. Then whether he derives income from a free zone person and whether such income derived from free zone person is an excluded activity, no, then it will be getting a benefit of 0%. If such income is from excluded activity, then check whether de minimis requirement is satisfied or not. If it is not satisfied, that means more than 5 million or more than 5% of the formula, then it will be taxable at 9%. Otherwise, it will be considered as 0%. So the excluded activity also will be eligible for 0% to the extent of de minimis. If you are dealing with a non-free zone person, whether such income is from qualifying activity that are not excluded, if that is the case, qualifying activity, 12 activities which are not excluded, then in that case, it will be taxable at 0%. Otherwise, it is if it is not from the qualifying activities, then you have to check whether de minimis requirement is met or not. Then if it is not met, if it is met again 0, otherwise it is 9%. The last leg of it, where it is kept, yeah. Attributable to domestic or foreign PE, taxable at 9%. This gives the complete scenario, complete solution. Both cabinet decisions are covered in one slide. Just one example. What about this one? What will be the taxability of this? Let's say exam test. 20 million total. Non-qualifying revenue is 500,000. 5% of 20 million is 1 million. That means it is less than 5% and not crossing 5 million. Then it will be taxed at 0%. One more question. 90 million plus 10 million. Total is 100 million. Percentage we have to apply 5 million. And the other figure also de minimis 5 million. Then since de minimis we earned 10 million and the limit is 5 million, it will be taxable at 9%. The last question. No, I need a few minutes. Because my 4 steps didn't come still. This 75 million and 80 million total. In this, whether tax is applicable or not, it's easy. The same formula we'll calculate, we know. Right. Yeah, I thought distribution activity is a confusing area. I thought of handling it in detail. Means 2-3 minutes. Can I? Yeah. Distribution is the confusing area. That's why I didn't touch it in the beginning. Distribution activity in free zone will be a qualifying activity. What is distribution activity? Trading activity in plain language, if you say, because we learned a lot in years 2 years, we were doing a lot of brainstorming. So we learned what is distribution activity. Then the point we have to look into, Article 2.1k of Ministerial Decision 139 says, this conditions, 2.1k says, the summary of it, distribution of materials or goods to a customer who resells or process and sell. Distribution, they resell or process and resell, sale. The condition are 2-3 of the same ministerial decision. The activity of distribution of goods or material, the summary of this one, the conditions, distribution activity in or from a designated zone should be in or from a designated zone, and it should be imported through a designated zone. Everybody is asking whether I see sale or importing from designated zone to mainland, or I am sitting in DMCC but goods are coming through designated zone and then mainland. Solution can be found out from this one. Looking into 4 thumb rules. What we should know? First, we should know who are you, yourself. Know yourself. That means whether you are a free zone person or non-free zone person. Number 2, KYC, know your customer. Whether you are dealing with a free zone person or non-free zone person. What is number 3? Kya? Know your activity. Kya? Kya karta hai? Then you will get your kit. KYT. That means know your tax. You should know yourself. That means your company is a free zone person or non-free zone person, eligible or not. Then know your customer, know your activity, get your kit. Let us go through this with an example. Designated free zone person dealing with designated free zone person, customer is designated free zone person. It is not an excluded activity. You have to check this designated zone area came as a qualifying activity. So nothing mentioned in excluded activity. So whenever you do from free zone to free zone, in this case, designated free zone to designated free zone, cool. You can decide it is as qualifying activity, not excluded activity. So it is 0 rated. What about this one? Free zone to another designated free zone to another free zone. Sorry. not taxable because it is not an excluded activity. When you are dealing with a natural person, it is not a qualifying activity, but it is not it is excluded. There is no exception to exclusion. So it is 9%. And in the case of mainland, when you are supplying to mainland, you have to check whether three conditions are satisfied or not. When you are importing goods, or distribution of goods or materials from a designated zone, and whether your customer doing, what activity your customer is doing, whether for resales, and whether the materials are entered into the UAE through a designated zone, it will be considered. If everything is satisfied, it will be taxed at 0%. Otherwise, no. Last point, to overseas. Here, the high sea sale also happens. If you say, are you able to satisfy all these requirements in high sea sale? No. This is the main question. Everybody asks, and all clients are having concern. Even we have concerns. Let us wait. Anyway, the next session will have a little more discussion on it. This is just to pass the time I kept. I don't have time now. The last kind of analysis is therefore one more activity. Should I do? Because you are doing a management consultancy in free zone. Taxable or not? You want to know or not? Okay, then I will cover this one. Otherwise, I will hand over to Rishi. Service activity. You are a free zone person dealing with another free zone person. Free zone person giving a consultancy service, management consultancy service to another free zone person. It is there in the excluded activity? No. So it is 0. Do any business, advisory or anything in the free zone. Number 2. But there are excluded activity also. I said about management consultancy also only, not excluded activity. There are service industry which are excluded also. Service activity which are excluded also. Reinsurance, fund management kind of activities. Non-excluded activity. This is 0%. That's what I covered there. Excluded activity will be 9%. Yeah, okay, So first one, banking, intellectual property, insurance related services will be 9%. And consultancy, logistics, etc. will be 0%. Number 2, free zone person to a natural person, services. All the service will be taxable. Except for whatever we mentioned, whether that is service or not, we have to check. There are service involved in that one. What is that? FAWAS, fund management, investment, fund management, wealth and investment management, ships and aircraft. Excluded activity except FAWAS. FAWAS will be charged at 0% only. So next one, free zone to a non-free zone person. Free zone to a non-free zone person, qualifying activity other than excluded activity. So there are certain examples, logistics, headquarter, etc. are qualifying activity, which is not excluded there. If it is excluded, then it will be 9%. Key takeaway that we can take it together, I think. This is also just a marketing slide. And this also. And this also. Thank you. Thank you so much.
Thank you, Manu, for the enlightening session which you have just shared. I'm sure there's a lot to explain about it in just few minutes. To cover such an important and what you call detailed section is not easy, but you have done a brilliant job. Thank you so much for your time. Appreciate it. Can we have a big round of applause for Manu? He has put so much efforts for us. Now I'd like to request our chairman, vice chairman, CA Ashna, and CA Nimish Makwana to please join me on the stage for give a token of love and appreciation on behalf of all of us to CA Manu. Thank you. Since there is a lot to cover, so I was telling Manu to see how we can wrap it up, but I can see, the preparation time and plus to keep it engaged in such a intriguing topic is very important. So we have to, thanks Manu for all the time you have spent. Moving on, our next session, 60 pages of UAE tax law was issued on 3rd of October 22 and was published in issue number 737 Official Gazette of UAE. On 10th of October 22. While we believed in beginning that it will be a cakewalk, and then comes the tsunami of publications. If I read all the names of all the publications which were published, I know it will be dinner time by that time, so I'll not do that. Though all decisions are important decisions, but considering UAE being a place where all multinational companies see it as a window to Middle East market, this makes two publications very important. One obviously is the explanatory guide on UAE corporate tax, published on 11th of May 23, which is nothing but a concerted effort from the authority to simplify as far as possible the intricacies of the federal tax law which was published. Second one is the participation exemption. We know local dividends are exempt, but there are specific rules for claiming exempt status for dividend from outside UAE and on the capital gains. On this, a separate ministerial decision was issued explaining answers to various practical challenges faced. Like one of the conditions in the participation exemption is that you should own like at least 5% or get profit to that extent. However, when we look at the balance sheet, we see a lot of different items like ordinary shares, preference share, redeemable shares, etc., etc. So this ministerial decision is actually to throw more light on how this participation exemption will work. To go through these important decisions, who could be a better speaker than our senior chartered accountant, CA Nirav Shah, who we all, already the applause has started. So let's do it. Who we know as a person with strong grip on tax and a knowledge powerhouse. Something I always personally admired about him is his sharp answers and his strong grasping power. To formally introduce our next speaker, CA Nirav Shah, I'd like to request our ExCom member, CA Dheeraj Nasaria, to please join me on the stage. So please, big round of applause for our ExCom member, CA Dheeraj Nasaria.
Good evening all. Like our first speaker, second speaker also not required any introductions. As you have done a lot of share the knowledge and experience with us in the previous also. And again, today he is going to share with us new, that I can say, decisions or the participation exemptions. But formally, before inviting on the stage, I will give some of his achievements, not introductions, his achievements. As he has secured 6th rank in the CA inter and 36th rank in the CA final. This is a very good achievement in the CA. Oh, he's become very good at clothes. And before he start his own practice, he worked in the KPMG as a transfer pricings and that international transactions. And then he start is at Fame Advisory DMCC as a director. And he had done a lot of webinars and seminars and a lot of platforms also, like our platform ICI and the Jane, Jito, IBBC, and more than 550 companies he has consultant. So not taking much time, please welcome with me Mr. Nirav Shah on the stage.
Good evening. Are you all ready? Or have you already understood everything? So I must congratulate Manu that he has done an excellent job when it comes to explaining such a difficult topic. Do you have the flicker? Or did Manu take it with himself? Okay. There it is. Thank you. Okay, so to explain qualified income activity and excluded activity in 40 minutes is not a joke. And you all will agree to that. And therefore, Manu definitely did a fantastic job. And of course, he has elucidated in a very simple manner, so it's easier for you to understand. But I'm sure there are lots of questions, and you received a lot of them also. So we'll take care of that in the next segment. Here I'm going to touch upon two important aspects. So you know that the law was 60 page, but they issued an explanatory guide which is 107 page. Okay, so they tried to expand certain meaning and certain connotation. We are going to cover that very, very briefly. And then we are going to touch upon the participation exemption and conditions related to that as important point, because that's must for getting the exemption. There are only two items on exemption, which you all know, dividend and capital gain. And you cannot get that exemption without having participation exemption condition being met. Clear? So we'll just touch upon these few things. There are few 8-10 parts, but don't worry, I'll not overshoot the time. Okay, so when we talk only of the tax law per se, right? We first got, the law got published, then we had plethora of various decisions, ministerial decision, cabinet decision and whatnot. Then we had this pleasure of receiving an explanatory guide, which was of course the big enough one. And of course the tax registrations are open now for a lot of people. We are going to touch upon few concepts which have been further expanded or have been clarified in explanatory guide. And why? Because these are terms which are very, very important to understand, because they have impact on a lot of things. So what I'm trying to do is trying to give you those expanded meaning, along with that some of the relevant parts that it has impact on. So first is business. It means any activity conducted with the intention of generating profit. Short-term commercial activity can also be considered, and its business activity term is wider than the business term itself. Okay, so again, just to get an idea why it is important, because you all know for individual taxation, the term business and business activity is relevant and not having a license, right? And therefore, just to understand that in that perspective, you don't need a license, but you can still be carrying on business. And you can, if you're carrying on business or business activity and your turnover is above certain threshold, you're taxable. Okay? So, why individual person or person who establishes a civil company in as sole proprietor, they are subject to corporate tax only in certain cases. Okay? So, we'll look at that one particular decision as well. Taxation of individual. We are only going to tax individual only if they carry on business or business activity where the turnover exceeds 1 million dirhams. Turnover, not profit, please. So we'll come to the revenue definition later, but that's the turnover, okay? Taxability of business and business activity is not linked to license requirement. It's very specifically mentioned in the explanatory guide. So you don't need a license. You can still be considered as carrying on the business. Please be clear. Of course, we know that the exclusions are anything that you earn as part of wage. So anything that is part of your employment contract and you earn, that is not going to be taxable. Anything that you earn as a personal investment income which is in personal capacity, not in company, please remember this, is going to be excluded as well. Okay? And most important is the real estate. So this was the biggest question before this decision came out, whether real estate is going to be taxed in personal hands or not. No real estate will be taxed, neither sale nor lease, anything, subleasing, rental, everything in personal capacity is excluded without any limit. So when it comes to exclusions, there are no limits, there are no threshold. Whether you earn 1 million, you earn 5 million or you earn 100, they are all excluded. Okay? So in this three category, if you fulfill in individual capacity, any income that you earn is excluded. And if you are earning excluded income, you are not required to register, file or do any compliance. So for individuals, please remember your trigger for registration is only when your income from business or business activity crosses $1 million dirham. Right? This is not the case for corporates. That's why I'm just highlighting this part very specifically to all of you. Now we come to an important term called revenue. Revenue, wherever it is defined in the law, it is used in 5 to 6 sections separately to determine threshold and other things. So wherever it is defined, it has connotation of a gross revenue. So non-operating and passive income also is included. Gross income means all income earned from all sources without deducting any type of cost. So in some of the cases, auditors, when they are presenting the financial statement, at times, they take the gross and deduct the direct cost attached to it and only represent net as a revenue number. Now that is a disclosure in a financial statement. But when you are looking at your thresholds, you have to look at the gross number without deducting any cost. Okay? Exempt income also is included as revenue. So again, all this threshold that we are talking about includes everything. Right? Why it is important? For small business relief, your 3 million threshold is revenue. Your audit requirement is revenue linked. So the term revenue is used in this 5 segment. Resident or non-resident natural person conducting business or activity, they say turnover. We are collaborating or corroborating it with the term revenue here again. Preparation of financial statement using cash basis. If you are below certain threshold, you can use, and maintaining transfer pricing documentation. All of this segment refers to revenue as a term, and that's why this term is all the more important for us to understand. Another important cost step is market value. Guess where it is going to be used? All transfer pricing related things, right? So everything that is connected with transfer pricing, you are going to keep hearing this term arm's length. How do you determine arm's length? With reference to a market value, right? Market value is defined as an asset or service or benefit provided as the value that the asset or service or benefit would ordinarily have in an open market at the time and place of the transaction. So you have to have relation to the time of the event that is taking place. At that time, what is the market price? And that market price is used as a reference. Okay? So it has to be for similar asset or service or benefit in open market if you don't have exact comparison. So these 2 aspects are also clarified as part of the explanatory guide. Where it is relevant, payment to connected person, related parties, business restructuring relief, and foreign permanent establishment exemption. Also, one more thing to add is the transition provision for the assets, where again the term market value has been used. So there also the same definition will apply for that purpose as well. Effective management and control. We all have been debating how will you bring foreign companies to taxation in UAE and what are the criteria. So law very clearly mentions that if there is a foreign company which is effectively managed and controlled from UAE, then that will be subject to, but they will be treated as a taxable person under UAE corporate law, and therefore is exposed to a worldwide level of taxation on that entity. Explanatory guide is helpful to provide us a very clear direction that what do we mean by this effective management and control. We are only going to look at strategic decisions and policy making and not day-to-day activity. So they are clearly saying that if there is key management and commercial decisions concerned with broader strategic and policy matters which are taking place in the country, then that is going to trigger the effective management and control. And here, please remember, even if your directors are not resident of UAE, but those board meetings are held in UAE, that can still trigger the effective management and control discussions. So, idea is to determine a place where such strategic or policy matters are decided for that foreign company. If that place be UAE, then you get covered. Okay? Why it is important? So, we said the tax residency and we compare it with permanent establishment. Because these are 2 concepts which use the similar terms. But the connotation or the purpose of using them is very different. So when it comes to tax residency, it is very important to have strategic and policy matter level discussion. And those decisions being taken in the country, that's when you trigger tax residency. And that's when you then get exposed to a worldwide level of taxation. When you are a foreign company, having a permanent establishment means that you are carrying on certain day-to-day functions or execution aspect and not necessarily the policy matters of certain activities are being carried on in a country, and therefore you are triggering a permanent establishment. But that will only trigger taxation for the income that attributes to that activity and not your worldwide taxation. So this is what is very important to distinguish when you are trying to analyze what gets exposed and what is not getting exposed. Right? And what do you trigger? For a foreign company, having distributor here, agent here, you're going to trigger P if at all some portion of that profit will be taxable here, but not entire thing. But if that foreign company has a seat of management here, then the entire worldwide income of that foreign company is going to be taxed here. That's why it's important to kind of differentiate between these two aspects. Just an example, we have a ABC company in BVI, but board of directors are in UAE and they are taking strategic and policy decisions here. Therefore, this ABC will have taxability of a worldwide income out here. Same ABC has employees here, right? And they are doing negotiation of contract, marketing function and all of that. So it will trigger the permanent establishment here. But then it will only expose itself to income which is attributable to that particular activity which is being carried on here and not to your worldwide level of taxation. And that's why it's important to distinguish these two aspects and clearly understand it. So UAE has a new law. It's one of the newest kid on the block for corporate tax, right? Countries which have had corporate tax law for ages are still to catch up with UAE in some respect. Most of the corporate tax laws do not have a permanent establishment definition included in the corporate tax law. Permanent establishment is a concept which came from double tax treaties, and it was restricted to application of those treaties because it's an extension of how you tax a corporate in a country. So when the normal method of applying your taxation based on registration, physical presence and all that failed, that's when the permanent establishment was introduced by OECD, by UN model and all of that, and that is history. UAE has that as part of its corporate tax itself from day one. Therefore, I do not need a country where I have signed a double tax treaty to invoke the permanent establishment definition. I have to only look at my corporate tax law. I am comparing our provision of UAE corporate tax law as far as permanent establishment is concerned with the international practices. Again, some of this have been clarified in the executive guide. That's why I thought we'll just mention it here. So we have a definition of fixed place PE, which includes place of management, where the corporate tax law and executive guide clearly mentions that where management and commercial decisions are taken, but decisions should be related to day-to-day operation of the business. When you go to double tax treaties and OECD guide, it just refers to place of management. The interpretation of that is left open. Here we are clear that we only want to tax when it comes to day-to-day administration and not necessarily everything else. Okay? Secondly, it is not required that a fixed place is owned or used exclusively by the person. So the disposal test, which is mandatory to be satisfied in a treaty arena, is not mandatory when it comes to UAE. So you do not need to have place at your disposal. That means even if you use a third-party service provider who is renting certain area to you, whether it is still not at your control, it can still become a permanent establishment for you. So disposal test, which is mandatory generally in the tax treaty context to be applied, is not mandatory here. And therefore again our concept is a little wider in its application. Okay, 6-month threshold for construction PE, whereas generally internationally it is between 9 to 12 months. Anti-fragmentation provision, we are slightly ahead of the time. Anti-fragmentation provision has been discussed as part of the BEPS discussion internationally, and OECD recommended that to be included in the commentary to effectively address the expansion of the concept that if you do few activities independently, if cohesively taken together, if they can be regarded as a PE, that should be regarded as a PE. Now we already have that in the law already, where most of the international tax experts have not understood this in entirety. We have it in the law. Okay, service PE specifically is not defined, but unfortunately, explanatory guide makes a reference to employees and third parties. So I would still say that explanatory guide cannot expand the meaning which is not there in the law itself, but there is a reference. So I would still think that service PE is not there in the law, but explanatory guide does have a mention. Nexus PE, we now have a cabinet decision number 56, which says if you have immovable property here, you have a nexus here. But that is not what the nexus PE was used internationally for. So that's a very narrow interpretation of a nexus PE. Here, the concept which is debated at the OECD and other international arena, the idea was to expand the PE application without having a physical presence at all. And therefore, the significant economic presence and few other concepts were being debated. Without touching those, UAE is only using immovable property located in UAE as a nexus for a foreign company to be taxed currently at the moment. This is just for the idea. Very important point that they are highlighting in the explanatory guide, that even if you go under a tax grouping, your corporate tax return could be single, but your withholding tax obligation as and when it will be implemented will still remain individual to each of your company. So you are not getting away from withholding tax obligation even though you form a tax group, and that remains with the each individual entity to do the withholding tax, file it and pay it to the government. So that's not getting combined as well. Transfer of losses, very important thing. We understood in the law that yes, I can transfer loss within a common ownership from one company to another. Now they are expanding it a bit, saying that you can transfer from one to multiple also. So if I have 5 companies in the group and one is not sufficient to capture all my losses, I can transfer to the other one also. So again, the proration can happen subject to the overall ceiling of 75% which is there. So just to give that idea home, just this is an example. So if you have a loss of 200 million and a company can only absorb 112, then I can transfer the balance to company B subject to overall having the common control at the overall level, right? Entertainment expenditure, they have further clarified that anything that you give to your customer, stakeholder, or all of them will remain outside, will remain subject to disallowance. They have not mentioned even in the explanatory guide the word employees. And therefore, we continue to believe that if any expense is incurred for the employees as staff welfare, that will not fall within the expenditure which is entertainment expenditure. So if this was an absolute opportune time for them, if they wanted to include that, to mention that very specifically. But that's not mentioned here and that's not mentioned in the law as well, right? Compensation paid to direct or indirect owners. Now this is very important for you to understand that on one hand we are saying that in the hands of individual, anything that is paid by way of a salary contract or a management contract remains excluded and therefore not taxable. However, if you are paying to an owner a management remuneration which is linked to your profits, and that will tantamount to profit distribution, and you will not get deduction in the hands of the company who is paying that. So your ability to deduct compensation which are profit linked paid to the direct or indirect owners have been restricted. And this has been again specifically clarified as part of the explanatory guide. So I just wanted to highlight this point. On interest, we have all seen the recent ministerial decision, where overall we now have a limit of 12 million as a threshold to trigger any interest disallowance, right? However, they've expanded the scope of the definition quite substantially. So earlier, we used to stick to the definition that it is only for use of money or for a debt obligation. So compensation paid for use of money or a debt obligation. And therefore, our reclassification as per IFRS and all, we used to think that that's not for a debt obligation, that's only a classification or a disclosure requirement. But now they specifically covered that. Further to that, all the guarantee fee, arrangement fee, commitment fee or any similar fee which is paid to raise a finance is also part of your interest expenditure. So whether you call it interest or not, it is part of your interest definition and your threshold should then take that into account and apply. Okay? So they have expanded the term interest while you compute it, but they have raised the threshold to be sufficiently high so that small and medium enterprises are not impacted, because your 30% EBITDA limit will only trigger after 12 million. So it's 12 million or 30%, whichever is higher, and not other way around, right? Deductibility of interest expense, they have clarified that interest expenses are deductible up to the limit which is precise, but also when you have excess interest, you will have to apply a first in first out method. So your first year of interest which was not deducted has to be deducted in the next year first and then taken that year's interest and then applied. So your 30% calculation will have to take into account the FIFO basis of rule. So again, specifically mentioned and highlighted, this is how you should be computing it. Now we are turning to participation exemption. Very important concept, because there are only two heads which are exempt, which is dividend and capital gain. When do you get exemption? For domestic dividend, there are no conditions. For foreign dividend and for domestic or international capital gain, we have conditions attached. What are the conditions? I need to have 5% of the shareholding. Now, all of you know that if you are going to trade in international equity markets, you may not reach that 5% level ever for an Apple share or a Tesla share or whatever. So they came up saying that, okay, in such cases, if your investment in that particular item is more than 4 million, which is about $1 million, then we will not trigger the 5% test for you. So if you are investing 4 million, your 5% test is met. Whether you got actually a 0.1 or 0.2 or 1 or 2 or 5%, whatever, we don't care. But your minimum investment size has to be at least 4 million. Now you have to hold that for at least a period of 12 months. This has to be subject to tax at 9%, and the other two operational conditions, I'm not going into detail. So these three are the main conditions, right? So one, we are saying that what is covered? Is it only equity shares? They came back and saying that no, equity, preference, even redeemable or convertible instruments, anything that you use or anything that you invest in, if you classify from your accounting standard point of view that investment as an equity interest, we will give you the benefit. So accounting standards classification is going to be important. Even if it is a redeemable or convertible debt, and if in your accounting standard, if you classify that as an equity interest, that can also get you entitled for this purpose. So again, your accounting standards, like we have seen in many other things, are going to rule your tax outcome. Okay, all type of ownership is to be aggregated. So if I own some in equity, some in preference, I need to aggregate all of that and look at overall at 5% level, right? Then debt instrument, if it is classified as equity, is also covered. And AD 4 million, this is what I mentioned, that if you invest above 4 million, then the 5% threshold is met. Then you only need to look at the other two conditions. Okay? So if in a single investment is at 4 million or above, you don't need to worry about 5%. Subject to tax. This is a typical area of debate internationally. I don't know if some of you are tax professionals, you would remember that under India UAE treaty, the majority of the litigation was on this topic. And then that's why they amended the UAE treaty a few years back in 2012 to address this entire aspect of subject to tax. Here, the ministerial decision clarified that anything that is considered as tax on profits will be covered in whatever name and by whatever nomenclature you call it. Okay? So all of that will be part of your corporate tax. All of that which is subject, which can be levied at a different manner. So you can have a withholding tax which is levied at a gross level. That can be levied in different manner, but that will still be part of the tax. If that tax rate at a headline level is above 9%, you will meet the condition. Now in some countries, you might get some concessions, some benefit or some exemptions. If those are specifically mentioned in the law, say for manufacturing, a few others, those will be valid. As long as the headline rate is above 9%, you will still get the benefit of having subject to tax. So that is also covered. Very interestingly, they have also mentioned that if the participant is subject to tax on income, equity or net worth, or a combination of any of all of this. So if all of you are aware, zakat is calculated not on your profits, but on a zakatable taxable base. So that also indirectly they have mentioned this here, that if you are counting your tax based on a net worth, that's fine. You have to then prepare an effective tax rate computation that the tax that you have paid is indeed above 9% of your profit. If you can establish that, you still get the benefit of being subject to tax at 9%. So that effective tax rate computation is something, again, you will have to demonstrate that you could do that and you could achieve that 9%, and it has to be as per the accounting standards. So you cannot employ your own methodology to do that as well. Right? So, if a company has two participation, one is in UAE, one is in SECO, Bahrain, dividend is exempt for local, no issues. And SECO, located in Bahrain, has no corporate tax, and therefore dividend will not be exempt. Right? Similarly, there is one important other aspect, that if I am part of a group, and if as a group I hold 5%, so one entity in the group holds 3, other holds other, but as a group I go on and own 5%, then I can also qualify that as together meeting the 5% criteria. So that also has been clarified and covered. So again, this is just to kind of, so here in the first example, the percentage is below 5%, but we are meeting the 4 million threshold, and therefore it will get the benefit. In the second one, because it is less than 5 million or 4 million, we will not get that even though the headline tax rate is above 9% rate. So that's all. Okay. So we will now look forward to our Q&A session, and thank you all for the patient and calm listening. Time mein.
Brilliant as always. Before moving forward, I'd like to request all the members to show a little bit, you can see it's a full house today. Thank you so much for turning up in large numbers. But we need your patience. We need your belief in the XCOM. So I want you to please be patient because the dinner will be served. So when the dinner is served, kindly see there is, if there are a lot of people sitting there, outside, then you please try to accommodate that pressure which the chefs are trying to handle. So I really appreciate your patience today. More important for us is to talk about tax than to worry about the arrangement. So I really will appreciate your patience, and I'm always available. All the XCOM, the chairman, vice chairman, all are available to help as far as possible. But we need from you is patience and believe in us. Thank you very much. So with that, I like to request our chairman, vice chairman, CA Dheeraj, to come on the stage along with CA James Matthew ji. Sir, please, if you can join for a token of appreciation for our speaker, CA Nirav ji. Can we have a big round of applause for Nirav ji again? picture with all the speakers. CA Dinesh Kothari ji to be on the stage with us for the group picture, please. Discussion answering list of questions that were received by us. A big thank you to all the members for taking time out to writing those important questions. And we are here with our learned speakers to answer most of it. Let's see if the time permits, we try to cover most of it. But what we have done is we have taken a list of questions based on the time available. We'll try to cover up. Otherwise, later on, you feel free to reach out to speakers if some of your questions are missed. So with that, I think I'd like to request our CA Manu, CA Nirav ji, Chairman and myself to be on the stage for the panel discussion. Can we please have it? And also at this moment, I'd like to also mention that our very talented CA Manu has issued a book, and this is the best moment when we have a lot of members in front of us. So he'd like to launch his book with us. So Manu, can we please do the honors with the launch of your book, please?
Generally, we estimate to the certain number, and I think it has already crossed the limit. So I really apologize for the inconvenience caused to you guys. And anyway, now we will take our next panel discussion session forward. Yesterday, I was watching actually the Deloitte webinar. And in Deloitte webinar, I think there were more than 972 people. And they asked two questions: whether you have understood all the cabinet decision, particularly pertaining to free zone, and whether you are ready to implement UAE corporate tax law. And guess what? There were 65% people who said, we didn't understand and still we are not ready to implement UAE corporate tax law. So I can understand, there are a lot of confusions. And I think, first of all, I would like to thank Manu. In such a short time, he has prepared this presentation, and not only prepared this presentation, presented so efficiently, and he has come up and published a book as well on the free zone, which is really a great achievement. Thank you very much, Manu. And Niravji has, I think, simplified participation exemption, particularly there were a lot of confusion. So for that, really thankful to him as well. And now I think, Devi और सजनों, I think let's start the कौन बनेगा करोड़पति. अमिताभ बच्चन तो नहीं है सर, but anyway, we'll try our best. I am just joking. We'll start our UAE Q&A session now, UAE corporate tax Q&A session. And let me take first question to Manu. I think this question was raised by Krishna Kumar, and he mentioned whether banking activity carried out from DIFC will be subject to zero tax rate. Does the answer differ if the entity is a DIFC-based branch of a Bahraini bank?
First, we have to check whenever the 4 steps I brought into. First, we should check ourselves, KYS. It's a free zone person, eligible to be a qualifying free zone person. But second one, we have to check your customer, whether to whom you are doing the services. It could be in mainland or in free zone, or it's be in free zone or outside the free zones, maybe in mainland or outside. Why I'm explaining this one? It is easy for us to understand how to handle all the questions.
Right.
Third one, we have to see what is the activity we are doing. Now the first step here, we have understood that it's a free zone person. If he is eligible to be considered as a free zone person, then we have to check whether the service is to mainland or overseas or within the free zone. In this case, it is a bank in DIFC giving service. Now we have to see, suppose it's a
excluded activity. Banking services excluded activity. So whether it is a free zone customer or mainland customer. For free zone, for mainland customer, if it is an excluded activity, it will be taxable. For free zone customer, if it is an if it is an what is excluded and the other one? Qualifying activity which is not excluded, then only. So, but it is excluded. So in both cases, it will be taxable. So free zone banking service will be taxable always. Now we have to take whether it is a branch of a foreign company. Branch of a foreign company. It is a branch of a foreign company is also eligible for to be considered as a qualifying free zone person subject to those. So all the conditions will be same. Only one difference will be there. Instead of 9%, the tax rate will be high. Because that is different scenario, that is Emirates level taxation, whatever the tax issue. For the corporate tax purpose, the taxation will be same.
Okay, I think, thank you, sir.
Right. Thank you, Manu. So the next question is for Nirav ji. The question is very simple and straight. So we'll just need your view on this. So taxability of sitting fees by other remuneration earned by directors having residency in UAE but residing outside UAE. So please give your views on this.
I think the question is, whoever has asked the question is slightly confused. So once we say you're tax resident in UAE, let's treat it as tax residency in UAE. Now you may be physically residing somewhere is your choice, depending on number of days or whatever you want to cover. Now, if we assume that the person is tax resident, is individual, is it part of a wage contract? The management fee or remuneration that is receiving. If it is not, and if it is only a service, up to 1 million, there is no problem. If it is exceeding that 1 million threshold, then it will become taxable.
Right. Thank you very much. So next question.
I think next question is from Nagarjan Ponuswamy to Manu. Free zone branch in a mainland, what will be the tax treatment for the branch and free zone company?
Branch of a free zone company, which will be a domestic permanent establishment, it will be taxable at 9%. That's the only question, no? Any extension is there? Vice versa.
And vice versa.
Mainland company having a branch in free zone, it's part of mainland, so there is no eligibility to be considered as a qualifying free zone person. Just to, this point was, I was giving this chance for Nirav ji earlier itself while beginning the discussion. Yeah, please carry on.
So in the explanatory guide, they have clarified that even if it is a branch of a mainland company which is in the free zone, is registered as such, you can still treat it as an independent entity for this purpose. So there is the explanatory guide segment which deals with that particular point. So a mainland company can have a branch in free zone.
Okay. Okay, thank you very much. I think
to reinstate that, so the branch of a mainland company will be equally treated as a free zone company. So it is not as per the law, whatever, as per the cabinet decision, but an extension and explanatory note has given for that one. Thank you.
Yeah, I think next CA Anil Pant has asked 3 questions actually, not one. So does corporate tax applies to every company or there are exceptions to it?
So as we have seen that generally all companies which are registered needs to register for corporate tax as well. Unless you are either a government entity or a government controlled entity, for which the details are not yet out. But otherwise, even if you are a charity and included in qualifying public benefit entity, you still need to register. So right. Registration is mandatory for everyone. Yeah.
Okay. Then is there any specific reporting or compliance requirement for an insurance company?
Yeah, but insurance company is now in excluded activity fully taxable.
Excluded activity already, yes.
Fully taxable. And therefore, you need to file all the return and whatever is applicable to you, transfer pricing and everything else. Yeah.
Okay. Next question is for Manu. I think Sanjeev Gambhir, he has really very serious question, Gambhir question. He has mentioned a mainland company with an overseas branch would be liable for tax for income earned by the branch, provided there is no DTAA with the country where the branch is based.
Yeah. Mainland company which is having branch overseas will also be taxable in UAE, but there is an option available. We can exempt also. In simple way, if the foreign branch of a mainland company is taxable in the respective country, then we can get a foreign tax credit. We can opt for exemption option also, that the entire income of that branch will be treated as separately and taxable separately, and then it will be can be fully exempted. Two options, either to get a foreign tax credit or to exempt it fully.
Right, thank you. Thank you very much, Manu, for that answer. So I'd like to request XCOM to take some questions from the members as well. So please, if you can just handle the mic. So just wanted to mention that we might not be able to cover all the questions, but need your patience. We will try to see how far we can go. Thank you. So the next question is for Nirav ji. Basically, one of the members has asked that his income has been declining in the last few years. So in 2023, he is expecting the revenue to reach 3 million. But in the past, the revenue has been on a declining trend. So can he claim the small business relief?
No, if in the past 2 years, your revenue has been above 3 million, even though declining trend or whichever way it is, if it is above that threshold, you will not be able to claim the SBR relief. But you will have to test this every year for next 3 years to check in which year you qualify, and then you can claim it accordingly.
Right, so this question is for Manu. Basically, it's about the designated free zone. So the question says, a designated free zone as a VAT registration will be also applied on the corporate tax, or there will be a separate notification listing the designated zones for the corporate tax?
Designated zone for, the question is whether the designated zone as per the VAT is as it is applicable or not. So as of now, we have to take that stand. And if the ministry come up with something else, because in the explanatory note it was given like this, if any other explanation comes in corporate tax law, then that will be added to that.
Right, thank you. Any question
only one addition, that the VAT law, you should refer to the latest circular on designated zone, not the old one, because in the latest one, they have put an end date for 3 of the free zones. So you just need to be aware that those are no longer designated zones.
Right. So any questions from the audience, please?
That is very important. Always you have to refer the explanatory note which they have given in last month.
So I have 2 questions, one from free zone and one for small business relief. One is whether all free zones of UAE is considered as free zone for this.
That's what just now we discussed also, clarified also. As of now, yeah, that is the designated zone related we discussed, but all the free zones are considered as free zones as of now. There is no exception. Did you see anything in explanatory note or anything? Nothing.
But the snapshot of, one snapshot is issued where FD saying you have to go back to your free zone authority and ask you are eligible. Is there any meaning to that?
Correct. So the relevant, so as per my understanding, whatever the licensing authority issued as a free zone, in a free zone capacity, that will be considered as a free zone. But however, we have time also. Let us reach out to the relevant free zone authority. The respective taxable person always can reach out to the respective authority and get a clarity, especially when economic substance regulation law was released or UBO compliance requirements were released. All the free zones were very active in compliance. So like that, we can expect also when we at least ask for the clarification, definitely all the free zones authority will respond to that. Okay. Otherwise, they may be updating that in their website or through any other methodology.
Okay, and the second question is for small business relief, for agents like tour operators and the travel agencies, how the revenue will be calculated? Will it be only their commission which will be considered as revenue or the entire amount? Yeah.
Again, you go back to your accounting standards. How do you recognize your revenue?
Yeah, I mean, a lot of people do differently.
No,
here.
sir. You have to follow IFRS.
Okay.
If as per that revenue recognition, you take only your share as the revenue, then you take it accordingly.
We'll take one more from the audience and then we'll go back to Hariji.
Yeah, may I? Yeah, okay. A DMCC registered company is engaged in general trading. Goods entirely imported from overseas and exported to a customer in yet another location outside. The goods don't come into the UAE at all. Would the income for such a company be taxable or zero?
It's a distribution activity.
Yes.
It's a distribution activity. That means trading activity.
Yes.
So trading activity related to compliance will be applicable for designated free zones.
Yes. So therefore it will be zero, right?
Yeah, it will not be. It will be taxable.
Entire income will be taxable?
Yeah, it will be taxable.
I think next question we'll take it from Krishna Prasad. I mean, he has asked 2 questions. Again, sir, थोड़ा तो consultancy fees भी दे दीजिए. 2 question पूछ रहे हैं और consultancy fees नहीं दो तो sponsor fees करवा दीजिए हमारे ICI दुबई chapter के लिए. He is asking if mainland company is doing exports, whether that would be exempt.
Should I answer or you want to answer? Yeah. Mainland company is doing export. The question is whether it is exempt. Anyway, it is not exempted activity. Now the question is whether 0% or 9%.
9%, yeah.
The 3 conditions has to be satisfied. It's not a manufacturing process. It's only a trading. Again, I'm coming back to the same point. If it's a trading activity, 3 conditions have to be satisfied. Number 1, whether it is for resales by the customer, know your customer. So it may be for resales. Then the other condition, whether the distribution activity is done in or from the free zone, designated zone. No. Or whether imported, the goods entered into the UAE is imported through the designated zone. Who knows? No. So in this case, it is taxable. Step by step, we can analyze all the categories of transaction because when we had conducted a session, so each transaction, everybody is asking. So, but once we follow the thumb rule, solution is there for all the questions, all the kind of transactions.
Okay, I think next question, same on the same line. He is asking if the company in free zone is selling goods to another free zone company, whether that would be.
Yeah. Let us answer together now. Step by step. Let us go step by step. Should we go step by step or going answer to straight away? Straight answer? Taxable or not? Not taxable. So we learned, that's what I said when we were discussing. So it's possible. Step by step, if we go, then solution is there.
Nirav, Kuldeep Mathur has asked one question. He is saying that, yes, there is a requirement in order to form a tax group, there should be 95% holding by the parent company in the holding, parent company in the subsidiary company, then only you can form a tax group. So whether that ownership, whether we need to look at the beneficial ownership or direct ownership?
No, direct legal ownership.
Direct legal ownership. In the license, whatever is there.
Because we have 3 conditions to satisfy for tax group.
Yeah.
One is 95% shareholding. Second is 95% of voting rights. Third is 95% of entitlement to profit. All these 3 has to be satisfied and it has to be a parent and subsidiary. So only when you do this together is when you get into a tax group, not otherwise.
Okay. I think we can take one question from the audience.
Yes.
Manu, any thoughts on the offshore company which are established in Jebel Ali offshore or that thing, and taxability of revenue or income earned by offshore company, particularly where how they will be able to maintain or satisfy the substance test as required by Article 18.
Yeah, let us answer it together. Whether the offshore company registered under JAFSA is licensed from JAFSA? Do you agree with that?
Registered in JAFSA.
Registered in JAFSA, it's a free zone establishment, free zone as per the JAFSA's procedure.
Correct.
Then we have to see whether the conditions, first to be a qualifying free zone person, you know better than me. So to be as an auditor, definitely you know, to ensure that whether the free zone company is, to consider whether there's a qualifying free zone person, we have to meet 6 conditions. Out of that, first substance. Can we prove that an offshore company is having substance in the UAE?
Except one scenario which I can visualize, where they have said outsourcing in the free zone person. So suppose I am having an offshore company in Jebel Ali free zone, I am having an onshore company in Jebel Ali free zone, and I am outsourcing.
Correct.
Then in which case substance can be satisfied.
It can be a related or unrelated also. But
Correct.
It has to be in the free zone itself.
Correct.
Whether it has to be in the same free zone or different free zone.
That is not provided.
That
I
is
think
not
law,
given,
the circular or MD, whatever
Correct.
it is saying, it should be FZP rather
Correct.
than in the same FZ.
Correct. I agree with you. Thank you.
I think the next name is kind of tongue twister. CA Kastub Durgavali, he is asking, is free zone entity exempt from dividends received from Bahrain? Very specific question, sir.
Yeah, so for dividend exemption, as we saw the conditions, when it is not received from a UAE company, you have to satisfy the 3 conditions. 5% shareholding has been held for 12 months and subject to tax of 9%. Now, we don't know the percentage of holding, but we are assuming that it will be more than 5%. So if it is more than 5%, it has been held for more than 12 months. Bahrain, by default, does not levy any corporate tax. And therefore will not fulfill the 3rd condition of 9% tax or being subject to tax. And therefore, dividend received from Bahrain will be taxable.
Okay. I think we can take one more question from the audience.
Hi. Regarding the same question, participation interest, there is also a clause that not over 50%. Can you just explain on that? What does that mean, not over 50% holding? If we are holding over 50%, will we lose the participation interest?
No. That's for different context. We can discuss that.
Yeah, if you, okay, so nothing to do with the participation, but it's in the same article it's mentioned, right?
Yeah.
Not over
that's
50%.
More continuing business and other conditions which you need to have for.
Okay, if the shareholding changes, that's what it means. Okay, fine, got it. Thank you.
Yeah, while the mic goes to another person, I can take the liberty of asking one question from Vishal Mehta. He's asking whether the income generated through sales to mainland company or free zone company is taxable or not.
Income generated by whom?
Income generated through sales to mainland company or free zone company is taxable or not? And further, if yes, how do we apportion the expenses and derive taxable income?
So,
I mean, he's deriving the income from mainland as well as from the free zone. Now, his question is like how he will apportion the expenditure.
So, first of all, we have to understand that the law is evolving. We started with a cabinet decision on free zone when it said that you only have condition which is linked to a free zone person. If you satisfy those conditions, then you get the benefit. Then when the law got issued, that goalpost was slightly moved to say that instead of condition being at qualifying free zone, yes, there are 3 conditions. You have to substance this, that. But then you have to have qualifying income. And then only you get exemption or 0% rate. Now, with the cabinet decision, they have further moved that to say that only if it is qualifying activity and not an excluded activity, that's when you come in. But also, more importantly, And that's where it is diluting to some extent the concept of the non-qualifying part. That if you have a de minimis, which is 5% level of other revenue also, you still get the benefit.
Right.
Right? So one needs to evaluate in that perspective as to how much is your income. First of all, are you a designated person? Designated zone, free zone person. Are you satisfying the qualified free zone person definition? Then you are designated person. Then if you are doing the distribution, whether to free zone or to mainland, you will qualify.
Right.
Both of them as 0%. But if you are not, then you might not qualify either.
Yes, you might have to pay full 9%.
That's right. So we need to understand, like Manu said, it's very important to go step by step. First you have to see where, how, what, and then apply it.
Right, Niravji. And just to add one leg to that one, because I think there was a confusion in the market also when the released last Thursday night, and then the WhatsApp circulations were going like anything, and then which we had the public consultation document was released, then we were having the confusion whether 1% if we do something non-qualifying activity taxable or not. For that clarity came. And the confusion was there that if any excluded activity is done, then it will be 9%. If any non-qualifying activity is done, then it will be 9%. De minimis condition is only a separate calculation, but here the clarity is that if excluded activity is within 5% or 5 million, then it will be 0%. Excluded activity also will be 0%. If you are not meeting de minimis, everything will be taxable. So the question is whether we have to segregate the income and expenses and arrive the profit doesn't arrive here. That was a confusion also there was confusions how to split it. You had to split the book only in two cases. One, foreign domestic person or foreign PE or domestic PE. You have to maintain separate books of accounts to arrive. And in the case of immovable property, you have to calculate it and arrive. That is the extension what I thought of discussing, which was having a confusion on this topic.
Thanks, Banu. I think we can take the question from the audience.
Yeah, hi.
Okay. Yeah, please.
Yeah.
Go ahead.
In the ministerial decisions about the interest expenditure, there was something mentioned on about the interest expenditure relating to the loans prior to 9 December 2022. So can you please clarify on this point?
No, I'm not very clear of the question, please.
In the ministerial decisions, sorry? Grandfathering loans. For
No, so yeah,
interest expenditure is 100%.
So if you are referring to the
historical investments.
Yes, if there are historical investment on which borrowing has been done, for which the interest is being incurred, that will be following the grandfathering provision is what is mentioned clearly.
Right. Thank you so much. Even the mic is choking, looks like.
Purely an investment activity that you're doing, but it's something that you do regularly on a continuous basis with an intention to earn profit. You will fulfill the business criteria, and there if your revenues then exceed 1 million dirham, then yes, you will be within the taxable net.
Right, thank you. There is another question which is from Rohit Borania. I mean, I think we have discussed this on a different way, but the question basically talks about two things. It says that, for example, if we are sitting in the free zone entities, say DAVZA or DMCC. So DAVZA and DMCC are different kind of free zones, first of all. And secondly, what he's trying to say, if we are doing trading of goods, and the goods are outside which does not touch UAE borders, that's question number one. So whether that will be taxable or not, question. That's for the goods part. Secondly, the question is about the service income. So if we receive service income from outside and the people are sitting in the free zone and giving the service outside, will that be taxable? So what's your views on this?
Should we discuss both cases? Or the first part is clear now? First part is clear, right? It is respected, that's why to this extent they have provided. To this extent in the sense, within the free zone, if we are doing an activity other than 6 categories of activity, everything will be 0 within the free zone. And if such 6 categories of activity also coming within 5% of your total activity, then also you are getting 0% benefit. That is only the happy news for us. Now, in this case, designated zone criteria to be met. One is in the Jabalali free zone. Davsa is also a designated zone. And the other one is DMCC, that is a free zone. So DMCC company, anyway, it will not be met because the designated zone criteria is not met. In the other case also, we explained 3 conditions to be met. Designated zone is met, whether doing business or managing the distribution activities in and from business, from designated zone, or imported into the UAE. That criteria is not met, so it will be taxable. The second part, service, it's a general question. We have list of services, and then we should know to whom we are giving the service is also natural person, or it's for a juridical person. All this criteria to be analyzed. So again, going from step by step, it's a free zone company, eligible for qualifying free zone person, doing service to a non-free zone person because it is doing service to overseas. Doing service to overseas non-free zone person, only qualifying activity which are not excluded will be eligible for getting the benefit. So not excluded activity, whatever qualifying activity done, they will be eligible. For example, logistics services, it will be eligible to get 0%. Management consultancy services, it is not a qualifying activity, so it will not get. Insurance activity, if we take, reinsurance activity, qualifying activity, which is not excluded, so we will get. But at the same time, other than reinsurance, if we do the insurance services, we will not get because it is excluded activity. So qualifying activity which is not excluded only, we will get the benefit. So let us, step by step, we will get all the services. We can decide 9%, 0% or taxable. Hope it's fine.
Right, thank you very much, Manu. I think before going further, I'd like to mention that the dinner is served. So those who want to have the dinner, please feel free and just be a little patient because we have a good turnout today, and you might face problems while going out with the parking and all that. So please accommodate, because our main aim is to educate to all our members. So that is our mission. That's why we are here. So I know it might be a little bit of problem here and there. So please request you to accommodate and help us deliver this session as beautifully as possible. So please, the dinner is served, so feel free, and in 100, maybe 50 to 100 people can go and then come back, and like that we try to accommodate. So please do accommodate there. Thank you. So moving into the questions. So this is another very interesting question, Niravji. It's for you, basically. Now it talks about interest on shareholders' loan. So we know dividend is exempt, local dividend is exempt. Then salary can be another part which can still be, a contract in place. But this is about interest on shareholder loan, whether income in the hands of shareholder will be considered as taxable income.
Interest on shareholder loans, individual shareholder has given shareholder loan.
Yeah, and receiving the interest personally. So whether that will be
so
considered.
Again, if it is not something that he does as business and lends to like 5-7 other people, it's only to his own company, then you can still claim it's an investment return that you are generating, and you can claim it as an exclusion and not taxable. But if you do it as a activity which you regularly give out as loan, then it turns into business, and then we need to be careful about it.
Right, thank you very much. The next question is also for you. Basically, it says, it's from Vaneet Singla. It says, income earned from views from YouTube or Instagram, FB and all that, and subscription subscription income is earned from all this channel, which is received in the free zone in Media City. How to determine if it is a qualifying or a non-qualifying income?
It's very simple. We follow the steps like Manu is saying. Are you a, first of all, qualified free zone person? Yes. Then you look at whether you're earning it from a other free zone person. Then you might get service income as 0%. But if not, and if in this case it is coming from YouTube or wherever, then it's not coming from other free zone person and it's not part of the qualified activity. So it will not be eligible for a 0% rate.
Thank you. So can we have questions from the audience?
Good evening, sir. My question is regarding the designated free zone. So we have, like for example, Ajman free zone is a designated free zone, but it has both companies which is within the gated part of the free zone and a non-gated part. So how do we differentiate between such entities when we are seeing trading activity?
It might be the reason why they came up with the other point also, that either as a VAT clarification or the designated zone definition, or with another decision which expected from corporates. I don't have a clear answer for this one. Practically, we are also facing the same difficulty.
Because the license doesn't
A designated zone, but it has to be customs controlled area. If it is within the customs controlled, then only we will be getting the eligibility.
Some questions from backside.
From backside. My question is, like when we are discuss about the interest earned by the partner, is that interest qualified as an spending for the business, interest paid to partner? And is there any limit or?
So for interest deduction, the overall limit that we discuss is same. As long as you book as an interest expense in your book, your 12 million or 30% is the criteria up to which you can claim deduction for the interest expense. So till that level, you can claim the deduction. As long as it is at arm's length, of course. So you need to justify because it's a related party. So it has to be at arm's length rate of interest and then it's fine.
And for claiming the remuneration to partner, the salary which partner is drawing, do we need to have an agreement registered with the labor contract, or a general agreement is sufficient?
I would say that agreement is required because the exclusion says wage which is earned as per agreement, right? Now whether it is registered with labor or not is still a grey area, I would say.
Okay, thank you.
Neeravji, there is a question from CA Mahesh Prabhu. As we are aware that real estate, any real estate income or generated by an individual is out of scope. But if he is having a sole establishment, in that case, what would be the implication? Still it is considered as real estate holding by an individual. Then he has asked third question, that if it is a single person's company, then what would be the situation?
Because it's a single person LLC, by default it has a constitution and it limits his liability. And therefore it is considered as a person which has a legal capacity which is independent from the shareholder. And if you consider it that way, then it is an independent person which, if that earns any real estate income, that will be taxable.
We can go for one question from the audience.
Has a business licensing. So if there's a business licensing required, then that income in the hands of natural person is not exempt. So which activities in real estate require business license?
Yeah, should I? Yeah. So what we have to look into, what I take a stand, if a natural person is having a residential or commercial property, which doesn't need a license to operate, to lease. Suppose I have a villa, if I lease it, it is my investment real estate.
Right.
Or if I own multiple villas or even commercial properties in my personal capacity, for owning real estate building doesn't need a separate activity license.
Okay. So where
So in this case, it is a personal investment in real estate. It is not taxable, no 1 million limit, and then whatever be the figure, it will not be taxable.
Right.
Suppose I have one practical example I'll share with you, which we are having. The property is owned by me, a natural person, and a sole establishment which is registered under me as managing the property.
Okay.
In this case, the law says, Cabinet Decision 49 says, the real estate activity done with a license or need a license to do. So in this case, wherever the permission is required from the UAE Tourism Authority, then we have to get the permit, we have to get the license. So in such activity where it is linked, without having a permit we cannot do, without having a license we cannot do. In that case, definitely it will become a taxable income, wherever such permit is not required. So it's an example only. So we have to look into, in the RERA's compliance, only the tenancy contract requirement, only municipality related compliance limited, whether licensing authority has to issue. In this case, we are practically seeing that it has to be, license has to be issued by UAE Tourism Authority. So in this case, it is taxable. So we have to look into the case by case and take a decision.
Okay, thanks. One more question. So if it's a local group, you have the mainland entity and free zone entity. Free zone entity is a subsidiary, but both are managed by the same set of directors.
Okay.
Now, if the decisions are taken on the mainland for the free zone entity, which is basically dealing in exports, does then effective management come into play?
Sir, you need to apply that only in respect of foreign companies,
yes,
and not for the local subsidiary.
Okay.
Local subsidiary, for your free zone benefit, is to establish that it has substance in the free zone, and
Yes.
that's about it.
Okay.
So it doesn't need effective management control discussion as far as a subsidiary which is within UAE.
Okay. Thank you.
I think one of our members, Niranjan, has asked the question, if there is a foreign company owning the real estate property in UAE, whether they are required to register for corporate tax.
Now with the new Nexus definition, yes. They will have to register and they'll have to pay.
Okay. I think we can take one more question from the audience.
Good evening, sir. Manu, thanks. This question is for you. Very simple, chopped up steps by step you can do when you do the analysis. The question is, a mainland company is buying from a designated free zone and the goods stay in the custom bound area. And then he is selling to another custom bound area, designated zone company, and the goods do not come out of the designated zone. So now corporate tax, will it come?
The company is in mainland, right?
Company is in the mainland.
Company, whether at any time, whether company will be eligible to get the benefit of a qualifying free zone person, like it has to be a juridical person registered in the free zone. Basic criteria is that it is not a juridical person registered in the free zone. So it is not a free zone company at all. Then only we can check the other steps. But for your VAT purpose, you may be enjoying it.
Yes, that is why I wanted to clarify on that one. Thank you.
Correct.
Yeah, Niravji, there is one question from our member, CA Pankhuri Bandari. If subsidiary is based in UK, but the poem is in UAE, in that case, whether corporate tax will be payable in UAE, and how about the local UK taxation?
Yes, so when we spoke about the effective management and control, we are saying that foreign companies, wherever located, so if it is in UK, if you can establish that the effective management control, that's a strategy level policy making decisions are indeed being taken from UAE, that will become a taxable person in UAE. Right. And therefore, even that taxable person, if it has paid taxes in UK, you will get up to the limit of your foreign tax credit.
Right.
So in both cases, we'll have to look at that, how much you can get the credit, because UAE tax rate is of course higher UK tax rate is of course higher than the UAE one.
Yes.
So you'll get the tax credit only up to 9% of the tax that you are paying here.
Right. Makes sense. I think we can take one question.
The question is, there is a natural person who is registered in free zone. So if you see the definition of free zone person, it says it starts with a juridical person. So will a natural person that is in free zone benefit from qualifying free zone?
Can you share your license copy?
Yeah, I'm having a practical case where...
I am also saying this is a practical issue, whether it is a free zone establishment with a limited liability activity, limited liability.
This is a branch of a sole establishment that is registered in mainland.
Mainland companies branch in free zone.
Yes.
Sole establishment.
Yes.
So it is a sole establishment natural person. I will take a stand immediately. It's a sole established natural person without referring the documents. Then further documents we can check later. Now, it is a confusing, and the reason is that even for us, free zone companies which are sole establishment, we have registered as a natural person for VAT purpose and as a legal person also for VAT purpose. So there also it is not very much clear. We may, how much we have to pay? 2,000 dirhams, so 1,750 for getting a private clarification.
Okay, so my second, it relates to explanatory guide. So in explanatory guide, as per the interest deduction rule, there it says interest which is related to exempt income, it can be considered as a prima facie as a deductible expenditure. So will this be allowed considering what is given in the Act? Because this is contradictory.
It is not actually contradictory. Even in the Act, they say that as far as the interest is concerned on the investment income or any excluded income, the interest will be subject to the tax deduction as per the interest limitation article. So it is not contradictory to the Act, and you will get interest as a deduction because that's not treated at par with any other expense that you incur for that exempt income to be earned. So you can get as per that interest limitation article.
Okay, thank you.
Free zone person and free zone persons and the LLC companies, okay, both are owned by the natural persons. Free zone person is a designated free zone, and they have outsourced their total logistic activity, and they have only small business unit in the Jabza. Now, the LLC company is completely managing it so they have to create the substance in Jabza to prove the purchase decision and sales decision, or only the logistic activity is sufficient?
No, what is mentioned is that to establish a substance in the free zone.
So the number of employees and office and everything has to be established in the free zone. So persons who are managing from the mainland all activity of the substance, all activity of the free zone, then the substance cannot be proved, so it will be taxable.
Yeah, it will be.
Okay.
Hello. What is your view on JOPs and master communities which are being, which are registered with RERA right now? So are they subject to corporate tax? Because in VAT, I believe there is some guidance, but from corporate tax perspective, any guidance available, or what's your view on that?
So currently there is no separate guidance, Rushabh, as you know, about such association which are registered. So they are not actually a legal entity in that sense, right? Yeah. But if there is no separate guidance and if they are treated as an independent entity for a law, you can treat it as a juridical person which will get subject to corporate tax as well. Unless you can fall within the unincorporated partnership provisions in some manner. But if you can't, then it will be treated as an independent entity.
So should we have to register?
Because there is a license issued to them.
Not the license, they don't have the trade license, they don't have certificate of incorporation.
Trade license, the registration with RERA.
That's right. They just provide a letter that they are registered with RERA.
That's right. So and then there is an association guideline, there are bylaws and what they need to do and what they don't need to do. So all of that is still there.
Thank you.
Thank you. I like to again mention that members, like there is now space in the dinner space, so you can go and have your dinner and come back. That way there will be no rush and inconvenience later on. So please accommodate us, and that will be really helpful. Thank you. So moving into next series of questions, or residential nature, that kind of a thing. So what they're trying to say, first question is we have a real estate which is given on rent and receiving income, both commercial and residential in the free zone, but that activity is not on their trade license. So as personally they're receiving that income, so should that be a taxable income or not taxable, being a commercial, residential? How do you see it?
Even though you are not conducting the real estate activity, but the income earned from the real estate property will be considered as a real estate income for that purpose. Now we have to see all the steps. There it is said that free zone company, they didn't mention it is free zone, right? It is
saying the property is in the free zone.
Property is in free zone. Company is in mainland or free zone. First,
that is not mentioned specifically.
That is not mentioned. So we will analyze both. A free zone company, which is having the property is in free zone and company is in free zone. Commercial activity done with a free zone person will be eligible for 0%. All the other three legs, commercial property with a non-free zone person, other than commercial property with a non-free zone person as well as free zone person, will be taxed at a 9% straight. Now we will come to mainland. Here I said that this is 9% straight when it is eligible for a qualifying free zone person. Now, if the company is in mainland and property is in free zone, there is no choice of qualifying free zone person's eligibility. It will get a benefit of 0% up to 375. In this case, but in my opinion, it is getting a better choice of getting a 0% benefit to the extent of 375% if the company is in mainland rather than companies in free zone.
All right, thank you. So Neerajji, next one is for you. Basically, it's like a Yorker question. You know, like the Yorker, if it lands right in the space, difficult to, but a good batsman can play well. I'm sure you will do. So it's about the managerial remuneration. So the question is there anything in the corporate tax about managerial remuneration? Because a lot of companies are planning to reduce their profit. So what is your thoughts on this?
You cannot artificially reduce the profit. That's the first thought. Okay, second, so anyway, there are no specific ceiling prescribed for managerial remuneration. As long as it is covered within the related party definition, it needs to be at arm's length. And therefore, by default, one will have to look at the reasonableness overall of the amount or quantum of the remuneration paid. And Janak Bhai has been teaching us that as per Commercial Companies Act, there is certain ceiling, there is certain amount. So we need to take care of all of that. But as a overall guidance, we say 12 to 15% of the profit. And if you are within that range, you should be able to justify that to be more at an arm's length and not excessively paid. And therefore, you can get that as a deduction, even if paid to related parties.
Right, thank you. Can we have some questions from the audience?
25% is there. Is it for only single individual shareholder or group of shareholders? If two shareholders together have one shareholding of 75% in both the companies, can that benefit? Because doubt is because in the explanatory guide, they have used...
So you are right, as contrasted with the tax group provision, where there is a 95% mandatory requirement. When you come to the group reliefs, the qualifying group could be direct or indirect ownership of 75% is fine. So it could be group of people owning together 75% in two entities, and we can still give that benefit.
Good evening, gentlemen. A shareholder charges director fees to, let's say, 3 or 4 of his companies, and the total of that goes above 1 million, is the director liable to pay tax in that case?
Yeah, if it is a commercial, if it's a business, it is not the category which is coming under 3 items, which is not a salary, or it is not an investment in real estate, it is not an investment activity. Then he is earning income. If it is going more than 1 million, definitely it will be an activity, a business he is doing and taxable.
My question is regarding the provisions, like provision for doubtful debts or inventory provisions like we are writing off. So is there any limit or anything given in corporate tax that we will allow till this limit, or we have to follow the IFRS?
No, sir. Everything is as per IFRS as of now. There is no any limitation given in any of those provisions.
And secondly, for the depreciation also.
Yeah.
Like in India, we have a separate
for the income tax
schedule.
purpose, there is separate tax rates and the life of the assets and all. But here there is nothing. It has to be as per IFRS.
Oh.
So which you are following the accounting, you have to continue as it is.
Okay, thank you.
If it is as per IFRS.
Sir, my question is regarding the qualifying income definition. So it says that the income from other free zones would be a qualifying income. Subclause 2 also says that the income would be considered as derived from free zone, where such free zone is the beneficial recipient of services or goods. So in practicality, how do you determine the beneficial interest, or what would be the checkpoints to see if that free zone is the beneficial interest?
The objective of the law is not to bypass the law, but just to route it through the free zones, and then the actual benefit is going to the mainland. For us to practically, because the agreement has to be there, and then all other, your business nature has to be matching, and then you should make sure that the services given or the goods are given to the customer, and all the documentation has to be maintained. Any additional point you would like to add with that?
So basically the beneficial ownership concept is like, it is with a view to prevent any unintended benefit being taken by artificially imposing entities. So as long as the entity is doing trade in itself, that's fine. But if it is not doing it on its own account, if it's only a front for other entity to take benefit of this clause, then you will not get such benefit. So you need to be careful whom you are dealing with. Is it not only a PO box office, and it is actually buying and selling those items on its own account as a part of its ongoing business. We don't know who is asking. If you can get
Sorry,
up. Yeah,
hi,
that's fine.
good evening. If one of the company registered in a tax-free jurisdiction, 2 nominee directors are in that jurisdiction, 1 nominee director is in UAE. The UAE director owns 100% of the company. Practically all policy making and board making decisions are happening in the tax-free jurisdiction. But still, shareholder, practically, does this cover?
So effective management and control is not linked to the shareholding. So even if I am 100% shareholder, if I am not taking the decisions of policy or strategic matters, then I cannot be alleged to have effective management or control over the company. So it needs very factual. We need to look at actual fact of how those policy level decisions are being taken, and then arrive at a conclusion. Merely having 100% shareholder based here does not by default make that company liable to tax here.
Hi. My question is in withholding tax deduction from Oman and Saudi. What is the position? Whether that can be taken as a credit here? Saudi doesn't usually gives any certificates for deduction also.
No, we are not clear about your question because your voice.
Maybe withholding tax.
So if it is withholding tax, you can get a credit in your tax payable up to the limit of UAE taxation. So foreign tax credit is part of the domestic law, and you will get it up to the tax payable on that amount.
Saudi is usually not issuing certificates for they want to create a PE there. So how does the position differ in case of Saudi?
No. Even in case of Saudi, if you have actually suffered payment of tax, you would have evidence of having paid the tax. As long as you have that evidence, you can claim the foreign tax credit, if that is what you are asking.
You see, the withholding tax is deducted by the party who is remitting from Saudi. Okay, so we have to get certificate.
So withholding tax will always be deducted by somebody else who is based there. If it is in relation to income which you are booking as a UAE company in UAE, then against your UAE tax liability, you will get the credit to the extent of UAE tax liability.
I think one of the member Yogesh Kodwani has asked one question. I think it's very simple. He is saying that there are two companies, one in DMCC and another one in mainland. Can he form a tax group?
You can form a tax group if you want, provided all the tax group conditions are met. But you have to take a choice whether you have to choose this free zone company as a qualifying free zone company or not. If you are opting to go as a qualifying free zone person, you cannot group it. You have to evaluate which is giving more benefit for you, whether as a tax group option or as if eligible as a qualifying free zone person, having a qualifying free zone person's benefits, that is beneficial or not.
Yeah, Manu, regarding this flexi disk in the free zones. So the substance part is doubtful, right? So what is your opinion regarding flexi disk?
In flexi-disk concept, when the substance criteria first we started discussing from economic substance regulations compliance onwards. At that time we had a difficulty in concluding it. Subsequently, the little more clarity came. Even the flexi-disk office license, they issue the tenancy contract with a very limited space. And it meets the basic requirements. If the activity which you are conducting, which needs only flexi-disk, and then authority also, the documents which you are having is reasonably establish the substance, and all other, that is the space related and all other activity, even though the flexi-disk and the business what you are conducting are meeting substance, then we can. But I don't want to conclude it in this question. Even you also know the practical difficulty of this to take a decision. Even in economic substance regulation, it's only a disclosure. Even if you, it's a disclosure requirements and there is no cost involved in that one. Here, revenue loss is there for the government. So we have to ensure that the substance is met.
Sir, somewhere I had read that registration is exempt for non-residents with state-sourced income. So
that is correct.
Yeah, so like the Facebook and other companies who are having the state-sourced income from UAE, then it is mandatory for them to register, right?
No.
Okay.
See, because there are two aspects to it. You must understand that today the withholding tax is 0. So the obvious mechanism of making them to pay tax was through the withholding mechanism.
Yes.
If you keep the withholding at 0, then there's no point asking them to register because there's nobody who is going to deduct that tax for them. And they don't have a place of business, so they are not mandatorily required to register. So when it comes to source rules, the only way to collect tax is two manner. Either you have a PE or you get withholding tax. So that's why they've come up with the nexus rule that if you have a PE in relation to the properties here, then you need to register, you need to pay taxes.
Yeah, but now for example,
because for Facebook and all, they don't have marketing presence in that sense. They might have an office here for marketing purpose and may or may not qualify in PE. We don't look at those. But the income that you are charged from is not charged from a local entity. It's charged from overseas. So then you are not mandatorily required. And that's where on registration itself, the cabinet decision was very clear that if
foreign company is only earning state source income, then they are not required to register at the moment.
And sir, taxability on the capital gains on sale of the assets for a juridical person?
Fully taxable.
On sale of the assets?
Yes. Capital gain exemption is only in respect of investment in shares. And therefore, capital gains earned on selling the shares or equity interest, as they have now defined, is the only thing that gets the exemption, not anything else.
Good evening, sir. I have two questions. One is regarding the question that individual is owning multiple companies and free zone companies and the mainland companies. And he is drawing as a managing director remuneration from all the companies, which is exceeding the limits of threshold or whatever, 1 million, 2 million dirhams in a year. Then whether this is taxable or not. And second thing, allowable in companies as an expense in that particular, each individual company as an expense. Second is a group of companies, they have common expenses incurred by the free zone company on behalf of a free zone company and mainland companies. And they cross-charge expenses with markup. So whether this will be taxable in the hands of individual company or not.
So first of all, I'll ask the second question first. So if it is free zone who is incurring the expense for the group and they are recharging it,
Yeah.
that amounts to surrendering the service
Yeah.
within, because it is within the group, transfer pricing will apply.
Yeah.
If the markup that we are charging is at arm's length,
Yeah.
then that's fine.
That's fine.
Right?
Yeah.
So that's number one. For the owner who is charging management remuneration to 3 or 4 entities.
Not linked to profit or anything.
So
Purely
if it is not linked to profit, you will get as a deduction, but you have to look at, because it is paid to owner, you have to look at the reasonableness, right?
Yeah.
So if it is reasonable,
For an individual company, yes, it is reasonable. But overall point of view, the thing is it's a big amount, say 5 million, 3 million, 10 million dirham in
so
a year.
we have to look at it from the company point of view.
Yeah, company perspective.
So as long as you can justify from a company point of view that is reasonable and within arm's length,
Okay.
then you get a deduction.
Thank you.
Right?
Thank you.
Should I go into business part?
Yeah, hello. Can you just please throw more light on this beneficial recipient definition? Exactly, I'm not very clear about it.
Recipients, you mean to say the beneficial recipient, the customer should be the beneficial recipient of the service or goods given. So there is an explanation given, and this point we already discussed also. It is to avoid bypassing this provision to take the advantage of 0%. If any service is given to a mainland company, non-free zone company, it should not be routed through another free zone and get the benefit. How normally it is happening in international services, like earlier transferring it through UAE. So the same way, free zone to free zone and then going to mainland or non-free zone persons. Should not happen, but to avoid the bypass. Yeah, should I read the definition? Third one. For the purpose of this article, the term beneficial recipient shall mean a person who has the right to use and enjoy the services or the goods and does not have a contractual or legal obligation to pass on such services or goods to another person, and the term good shall mean tangible or intangible property that has economic value in dealing with including movable and immovable property. So the purpose is to ensure that the beneficial, the customer has got the right to use and enjoy the services or goods. What is it? It can be a trader. In my opinion, it can be a trader because it can be. If it is that purpose, it is not for contractual obligation. That's what it is mentioned, contractual obligation.
Because if it's a trader, then it's okay. But if it's not a trader, only the end user, then it becomes problematic, basically.
Yeah, we had to see that. No, the objective is clear. It should not bypass. If we are able to prove the documentation for that purpose, we are meeting the requirements.
Good evening, sir. Couple of questions raised on goods imported outside UAE and exported outside UAE by a free zone company, clearly taxable. How about the freight related to that? It's a service. Import of service, if it is CFR basis, we are importing both goods as well as freight is also associated with that. So how to bifurcate this?
In both excluded activity and qualifying activity, it is mentioned that anything incidental, ancillary services also will be forming part of it. If we are able to bifurcate it in the case of logistics, for example, it's a qualifying activity. If we are able to segregate the logistics services separately, it will be a qualifying activity. If we are not able to, then it will be forming part of it. In the same way, it comes that goods, sale of goods and installation of goods. So installation, if we are not able to, it's part of it, then it will be manufacturing and installation, for example. It will be part of manufacturing. So we have to take a stand what is the actual scenario, and then accordingly we have to take.
Then the services comes under your acronym FWAS, the services of this one, revenue. So my sole business is like arranging the freight revenue. Okay. So I arrange the vessel which is outside UAE, for that the cost is also the same thing, like supplying along with that this thing. So does it not come under this FWAS acronym, this operation and management of ships, this freight revenue?
That's applicable only for natural persons.
Free zone?
Yeah.
Not for free zone company?
No, natural person, whether it is in free zone or mainland, it doesn't have any difference.
Okay.
Everywhere.
So we have to bifurcate this FOB part and then freight part always like...
Wherever possible, to contractual obligation, we have to see how the contract is made.
The balance sheet as of 31st December 2023 will be the opening balance sheet as of 1st of Jan 2024. So can you give some tips? I mean, that's what she's asking.
Tips. So all cleaning up you need to do now. And you need to bring your accounts, your balance sheet, your financial statement in shape to make it acceptable from a tax perspective. And therefore, a lot of groups currently are busy writing off all their old balances, squaring off all that, and all of that is going on. So the whole idea is that you need to have a discipline around your financial statement. And what is the most important aspect is that those in that balance sheet, if you have related party balances, then those needs to be determined in advance to be at arm's length. So those are the things that you need to check beforehand, before you close your financial year for this year. So a lot of cleaning up from accounting point of view is required.
I think Manu has mentioned a lot of steps. Know your activity, know yourself, know your suppliers, customers.
Know your tax.
Now, we are going to organize one seminar on 17th of June at Movenpeak Hotel. And there, we have to remember now KYB, know your balance sheet. Because earlier we were always focusing on the income statement, on the performance, and nobody was bothered at the balance sheet. So it's the right time to look at your balance sheet item by item detail. And in this next seminar, definitely our expert speaker will be sharing his views on the know your balance sheet and what actions you can take from now till 31st of December in order to close your balance sheet accurately from the tax point of view. Is there any other question from the audience, or I think Mr. Anthony? This will be the last question because now we are having 1 minute more. So one question we can take it up.
Sir, I have a question related to the real estate. The real estate owners are not natural person and not juridical person. It's by way of a court order. For example, the father is the owner of the property and he passed away. then the court ordered to, like there's a court order that all the daughters and sons, like legal heirs, are the owners of the property. So it is managed by one person, and how we can treat it?
You are not clear. Can you slow down and tell me clearly what you're asking? You're not able to understand.
Okay, this is related to a real estate property. The ownership of the real estate property is based on the court order. Not natural persons are owning it, not a company. So the court order is based on the expiry of the father. The court ordered to make a separate agreement that one of the son will be the managing of the property and all others will be the, it's a joint ownership basically. But
no, that will be the legal heirs or the
yes,
estate
correct.
of the person which is owning it.
Correct, correct. So the court order is also mentioning that the ownership is legal heirs of this person, like that. So we can take a VAT registration based on this court order. Is it possible to take a corporate tax registration, or how we can treat it? Is it taxable or not taxable? Is there any idea about
you
that?
can consider this to be a jointly owned property by the legal heirs.
Yeah, yeah.
And if you have your proportion which are clearly defined,
Yes, yes, it's
then you
clearly.
can apply that and take it in their individual income and avail the benefit of the individual.
Okay, so
rather than doing it. Estate is not a juridical person.
Yeah,
it's not directly covered in the corporate tax law.
Yeah.
In fact, even though there are some juridical person, they give pass-through benefit to foundation, to unincorporated partnership. So you can take it on the same basis. And if you're still unclear, we can go for private clarification.
Okay, thank you.
Message that the handbook which we developed, I appreciate our team. And my colleague Purvi Mehta, she was not here, that's why I could not invite her earlier also. She is the master brain behind that one who worked, our team. Many other chartered accountants also worked for last 3-4 days and made it to happen. So this is the teamwork, how I am able to present it in front of you. So I admire my team to give that support and to create it. Thank you so much.
Hello, sir. So this is going to be the last one. So please, no more questions from this. After this, thank you. Only one, please. Only one, please. Sir, one-to-one, please discuss one-to-one. I request you. They are here. They are here for dinner afterwards. So please.
I'm basically referring to tax group, 100% owned subsidiary, loss making. Permanent effective management is in the UAE, not in a jurisdiction which is saying 0% tax. So can you group it and take the benefit of the loss?
So you have a parent and subsidiary which
Absolutely,
are in
100%.
UAE.
Yeah, the
And it's
subsidiary is
100%
outside.
owned.
100% owned. Parent is in the UAE, subsidiary is overseas.
No, foreign companies are not allowed to group. Only local parent subsidiaries can group.
Right, thank you very much. Thank you everyone for joining. So big round of applause for the panelists for spending so much time and energy into it. But we must not forget about the silent players, who is our ExCom members, Sanjay, Malvika, Ashna, Dheeraj, who has spent a lot of time at the back end to ensure things happen smoothly. So big round of applause for them. By the way, the raffle draw is still there, so just wait a moment. So before the raffle draw is given, we like Sanjay to give vote of thanks. Thank you.
Honorable Chief Guest, Eminent Speaker, Mr. Chairman, ExCom member, my professional colleagues, ladies and gentlemen, good evening. It's my privilege to have been asked to propose a vote of thanks today. I, on the behalf of ICI Dubai chapter and entire ExCom, extend a very hearty vote of thanks to all the speakers for gracing the events and making it a grand success. A big thank you to our chief guest, CA Dinesh Kothari ji, for highlighting the moral and social duties of our finance professionals. I must mention our deep sense of appreciation, our eminent speakers, CA Manu Nair and CA Nirav Shah, for demonstrating and providing key insight on corporate tax law. It's my duty to thank our sponsor who are always supporting to us. Thanks to our title sponsor, Bricks and Boots, principal sponsor, Stocks and Ground, MBG, AGMC, Tally, IFCO, and Lulu. Our platinum sponsor, NUF Chartered Accountant, WHY James, WMS, CloudSook, Emirates Chartered Accountants Group, SBC, Nelsoft, Jadox. Thanks to our FMCG partner, Actia, media partner, Kalistine, institutional partner, Delhi Private School, banking partner, Bank of Baroda, magazine partner, Finance. Many thanks to all the participants and who are available here physically. Have a great evening. Over to you, Mr. Secretary.
Thank you so much. So anything which ends with a prize is always beautiful, isn't it? So here we come for the raffle draw. So I'd like to request Chairman Saab to please draw a card.
I have one last question, but not to the panel, but to the committee members. If the person whom we pick as a lucky winner, if he's not there, present here, will he be the natural person or legal entity? So if we can decide on that, so there is no absolutely, confusion. So person who is present here, so the person who is present here would be the winner. And I would request Mr. Hariji to do the honors, please. And the winner is Mr. Ramesh Srinivasan from... So no natural entity. Okay, this is from Danube Group, Linda Ignatius. So please tell me who's here, I'll take that name out.
Gunjan Kumar? Oh, Gunjan Kumar was asking one of the question and then he actually gave up on that. So that's the reason, sir, universe has given you back. Please come on the stage. Can we have a big round of applause for Gunjan? And for our travel partner, Uranus Travel as well.
With that, we come to end of the session. Thank you and have a very good night.